Good morning, and welcome to the second Irish Auditing and Accounting Supervisory Authority Audit Committee briefing. We hope you find this morning informative and that you come away with a better understanding of your role as Audit Committee members and of the developments you can expect to see in the area of audit and financial reporting over the short to medium term. First of all, our disclaimers. So the views expressed today are our own and our panel members and other speakers and do not necessarily reflect the views of the authority, the board, or the staff of IAASA. This presentation, extracts or sections thereof, may not be published or distributed to any third party without the express permission of IAASA, and this event will be recorded to be uploaded on IAASA's website. So, by attending this briefing, you are giving permission for any contributions you make to be recorded and uploaded to IAASA's website. And slides from this session will be circulated afterwards. In order to make this briefing as engaging as possible, for some of the sessions we will be using Slido. This will allow you to participate in polls as well as pose questions to speakers. And you can pose those questions either under your own name or anonymously. This year, Slido is now built into our online presentation platform, so there is no need to input your responses on your phone or the app. Just complete them on screen. Similar to last year, we will have questions for a number of sessions and we will be uploading them throughout the sessions. But please feel free to raise any questions yourself and we will try to get to them in the Q&A at the end of each session. So we opened up this morning's session with 2 Slido questions which you were encouraged to complete while you're in the waiting area. So to remind you again of those, the first is what do you hope to get from this year's briefing? And then going forward, what format will audit committee meetings take? Will they be physical? Will they be virtual? Or will they be hybrid? So we're going to give you a chance to respond to those now. And in the meantime, we will take you through this morning's agenda. So after I finish, my colleague Lisa Campbell will give an update on the regulatory landscape. She'll be followed by Martin Kelly. He will give an overview of the audit report, its key messages, what it's trying to say, and also the issues that can arise and the issues that we've observed as part of our regulatory regime. Then we will have the panel session on audit reporting, audit expectations, and the annual report, and then we'll take a brief break. Following the break, more colleagues, Barry Murphy and Kieran Leddy, will give an update on the work of our Audit Quality Unit and its ongoing and prospective engagements with audit committees. And finally, we will have Alain Deckers as a guest speaker from the European Commission. He's head of unit in DG FISMA, overseeing audit, corporate reporting, and credit rating agencies. And he will be giving an EU perspective on regulation and financial reporting. So just to note, we have had a very late change in our agenda. Unfortunately, Ken Bowles, who was supposed to speak on sustainability reporting and the audit report, has taken ill at short notice. But what that does mean is we will be finishing slightly earlier than scheduled at 11:35. So we've one further question we want you to reflect on over the course of this morning. And then we will see what themes are arising at the end of the briefing. And that question is, what do you see as the greatest challenge facing audit committees in 2022? So we might now go back and look at the answers coming in to our first 2 questions. So the first question, what do you hope to get from this year's briefing? Well, insight. I hope we'll be able to provide you with all sorts of insights, both from our guest speakers, our panelists, and indeed the IAASA team as well. Updates and information concerning recent developments, and we will be covering that throughout, both from a European perspective and from a national perspective. And indeed, Lisa, who's coming up, is going to cover some of that. Experience, advice, and knowledge, we'll have a wealth of that from our panelists, and I'm looking forward to that session myself to get their perspectives. How audit committees perhaps can bring better challenge and how they could be more effective. Again, we have very experienced audit committee members and very experienced audit partners, and they can speak to that as well. Updates on best practice, a lot of stuff there about updates. We will provide as much information as we can, both on what's happening currently and what's happening, or what are the proposals, especially the European proposals that are coming down the track in terms of corporate sustainability and the single electronic format, the single access point, all those sorts of things. And I suppose to understand what audit committees want from the external auditors, again, our audit committees and external auditor panelists will hopefully be able to provide good insight in relation to all of that. So if we might move on to the second question, which talked about the format for audit committee meetings. So 88% are saying they will be hybrid. So that does reflect, I suppose, the fact that audit committees could be international or perhaps have people from all over the country. And there are certainly savings and efficiencies in terms of time and money in having hybrid meetings. All virtual 9% and all physical just 3%. So some of the debate there has been maybe around some of the inefficiency in a hybrid meeting and the challenges of hybrid meetings. Clearly, that's not something that audit committees appear to be overly worried about, and hybrid seems to be the way we're going to take this forward. So they were great, and thank you very much for those. So I'd now like to kick off our first session, and I'll hand you over to my colleague Lisa. She will give a high-level overview of some of the changes that have occurred and are coming down the track in respect of the Irish auditing and accounting regulatory landscape.
Thank you, Kevin. So I'm also going to start with a Slido question, which you'll see on the right hand of your screen. So this question is, how many of these IAASA publications have you read? So we have our financial reporting supervision observations, our financial reporting supervision decisions, our audit quality inspection reports, thematic reviews, our AAPA report, the annual report, and the profile of the profession. So we'll give that a minute and then we'll get the results up. Okay, so this is looking good. So the most popular one seems to be our audit quality inspection reports, followed by our thematic reviews and our annual report. And that is changing as we go. Okay, and what I would say is, if you do have any feedback for us on ways that we can improve our existing publications, or any other suggestions for publications that you'd like to see from us, please do let us know. So in this session, I'm going to cover a couple of items, both internal to IAASA. So looking at our financial reporting priorities for the year end, our changes to auditing standards, derecognition of accountancy bodies, and then looking outside of IAASA at some other Irish legislative amendments, and then an update on the global developments in the audit and accounting environment. So firstly, I wanted to talk about the priorities for financial reporting for the 2021 year ends. There are two key documents that set out financial reporting priorities at an Irish and European level. While both these documents are designed with the regulation of listed entities in mind, the messages do apply to most companies preparing financial statements, so we would encourage everyone to read them. The IAASA observations document is available on our website, and a link is included in these slides, which will be circulated after the session. The ESMA document will be published later this month, and if you're registered on IAASA's website, you'll get a notification from us when that's published. So there are two common themes in those documents that I wanted to mention today. Firstly, the impact of COVID-19, which remains a significant matter in financial reporting. So hopefully we're going to continue to emerge from the pandemic, but companies need to continue to consider and disclose the impact that COVID-19 continues to have on their business and financial statements, and any impact that it might have going forward as well. So it may be that government supports are being taken away or consumer behaviours have changed long term. And this is all information that is relevant to users. Also, anything that requires the use of forward-looking information remains very uncertain. And disclosures of any such forward-looking assumptions, as well as sensitivity analysis, which would demonstrate the impact of any differences in those assumptions. That's all really vital for users. So most companies have been impacted in some way by the pandemic in the last 2 years. And it's really important to let users know what that impact has been and what the recovery phase will look like for your company. The other common priority item is climate change. So we'll hear from Alan later that there are proposals at Commission level for climate change reporting. However, IAASA and the ESMA documents note that companies shouldn't be waiting for those European changes, and disclosures need to be considered now. So government policies on climate could impact on useful lives of assets, the residual values of the assets, and there could be contingent liabilities or provisions needed for future requirements for remediation or to redesign products to be more green. Moving on then to auditing standards. So the international standard setters have developed a new set of quality control standards for auditors. They're known as ISQM1 and ISQM2. And IAASA has an open consultation at the moment about bringing those standards in Ireland. The new standards require firms to have an integrated and iterative approach to proactively managing quality. So this is a big change for firms and will have a really significant impact on every firm in the country and in the many countries worldwide that adopt the international standards. The larger networks have already been preparing for the change for some time. So audit committees may wish to ask their audit firms about the preparations they are making for these changes. Also, just yesterday, IAASA issued an adoption of a revision to ISA 240, which sets clearer requirements for auditors relating to their responsibilities for fraud. The standard enhances what auditors must do during the risk assessment phase and then specifies what the auditor does next. So again, we would suggest that audit committees may wish to ask their auditors what impact the standard might have on their audit. The last thing I wanted to mention in this area is that the international standard setters have issued a draft standard which aims to be a single standard for auditing less complex entities. And this has been developed partly in response to the fact that some jurisdictions have developed their own standards for such entities. And the IAASB wanted to maintain some international consistency in this area. So while there is some enthusiasm for this in the market, there are also concerns about the concept of having a different type of audit for less complex entities. So we know that there's already an expectation gap between what the general public expects an audit to do and what the law and standards require an audit to do. And then there's scope, we think, for this less complex entity to complicate this expectation gap further. So IASA will be carefully considering whether this would be appropriate for the Irish market or not. Moving on to the derecognition point, you may have seen that IASA revoked the recognition of the Institute of Chartered Accountants in England and Wales in July. And the Institute of Chartered Accountants in Scotland have applied to be derecognised in December of this year. So IASA and the accountancy bodies have put a lot of focus in recent years on ensuring that people who are on the Irish Auditor Register are qualified and should be there. So there's no longer an automatic inclusion on both the UK and Irish registers. And going forward, it will become increasingly difficult for UK auditors to be eligible for approval in Ireland. EU legislation requires auditors to have practical training with an EU statutory auditor in EU statutory audits. So audits of UK entities will no longer count for that experience. All of this has resulted in these two bodies making the decision to exit the Irish market. This will mean they can no longer issue audit licences in Ireland, and it means that their members will no longer be regulated in Ireland. So from an audit committee perspective, again, first point is you should ensure that your auditor is registered in Ireland still, and also consider whether there's any employees or advisors who are no longer regulated in Ireland, and consider whether there's any impact on that. I'll briefly mention two other significant legislative developments related to companies and company law in Ireland. The first is legislation that is nearing finalisation for the establishment of a new corporate enforcement authority. This authority will replace the ODCE and will have increased powers and functions to investigate corporate crime. This authority will continue to investigate any criminal breaches of company law, including any related to audit. Secondly, for financial services companies, the senior executive accountability regime will be a significant change. So companies in scope will be required to assign specific responsibilities to individuals, and those individuals could then be held to account by the central bank in the event of something going wrong. So this regime will interact with the existing CBI fitness and probity regime. Looking a little further afield then, some recent accounting scandals have focused minds in terms of the European reform agenda. And there's a number of different initiatives in progress at the moment, which could result in significant changes for the audit market across Europe. The first is the Commission's study on the application of the Audit Directive and Audit Regulation. And we'll hear more on this from Alan shortly. In parallel to this study, we're seeing a drive to harmonise both corporate reporting with the rollout of both ESEF and CSRD. So that's a lot of acronyms. So starting with ESEF. ESEF is the European Single Electronic Format, which is electronic tagging of financial statements, which makes them machine readable as well as human readable. So this was due to come in last year, but we were given a 1-year delay by the Commission due to COVID. And companies in scope will now be required to produce their financial statements for December 21 year ends onwards in this electronic format. If your company is in scope for ESEF for 2021 year end, it's really important that you have everything lined up to allow those financial statements to be tagged before your audit opinion is signed. And this could have an impact on your reporting timelines. You may have seen that the FRC Lab issued a report yesterday with the results of reviews of over 50 ESEF reports. And that report said that more than 70% of the companies reviewed had tagging errors. And it highlighted the significant effort involved in preparing financial statements in that format and the potential impact on your timelines. So even if your company is not in scope this year for that, it's worth keeping an eye on it because the scope could increase in the future. And also sustainability reporting changes may require sustainability reports to be tagged in this manner as well. Moving on to CSRD, which is the Corporate Sustainability Reporting Directive. There's a very ambitious target being set for that, with potentially a large number of companies required to comply. It seems likely that assurance is going to be required on those disclosures, and that assurance could be provided by the auditor, but there's also a proposal to open it up to other accredited assurance providers. So given that there are lots of standards that need to be adopted, the timeline for a potential 2023 rollout is really tight. So we really encourage companies to monitor these developments carefully and to start planning. We can see from the Commission's second market monitoring report, which was produced with the assistance of the CEAOB, which is a European body of audit regulators, that Big Four concentration has not changed dramatically since the introduction of the regulations. And this is a regular topic of discussion, along with joint audits and the provision of non-audit services. So it will be interesting to see if there are any proposals going to be made in this area. Lastly, the role of the Audit Committee and the current role of enforcers is also under scrutiny, and it remains to be seen whether changes will be coming down the track, such as increasing requirements on audit committees or reducing the scope of audit committee exemptions, as well as strengthening the role of enforcement agencies across Europe. There are a lot of things happening in the UK as well. So there is a white paper on restoring trust in audit, and that draws together the results of a number of different reviews that have happened in the UK in recent years, including Kingman and Bryden. So the white paper has proposals impacting preparers, auditors and regulators. And some of those are really very significant. And they include proposals such as a new SOX type regime, shared audits, and a new professional body which would only focus on audit and not accounting and audit, as is currently the case. So historically, given the close links between the UK and Ireland, developments there have influenced policy and legislation here. But Ireland continues to be aligned with the EU. However, the developments in the UK are being monitored, and if there's evidence that proposals improve audit quality, they could be considered here as well. Looking a little bit further afield to the US then, there is a new act aimed at holding foreign companies accountable. So in summary, what this act says is that if the PCAOB, which is the US auditing oversight body, is unable to inspect an audit that they're interested in due to a position taken by a foreign regulator for a period of 3 years, there will be implications for companies. So initially, the companies will be required to disclose that fact. And if the situation persists, the companies may be required to appoint a different auditor. Now, for those in Ireland, this will not be an issue because IASA has an agreement with the PCAOB and we facilitate joint inspections of audit firms who are in scope for PCAOB. So I've just included some useful links to some of the documents that I've discussed, and I will maybe turn over and see if there are any Slido questions at this stage. Okay, so the first question is, is the ESEF electronic tagging of financial statements the responsibility of the auditor or the company or directors? And it is absolutely the responsibility of the company and the directors. Auditors cannot do this for you. They do have to audit it, but they cannot do it for you. That's a prohibited service. So you need to arrange your provider, if you're going to use an outsourced providers, to prepare this document for you and then hand it to the auditors in time to have it audited for your reporting deadline. So it is really quite onerous, and there's a lot of planning involved in this. And what we've seen from other countries and heard from other countries who may have done this last year is that really don't underestimate the amount of planning involved. And I think the phrase regularly used is test, test, test. So another question, have I seen or read anything to date in the Bayes report that I could see being taken up by the Irish regulator? So what I would say is, for the most part, the proposals are legislative proposals. So that would be a matter for the Department of Enterprise, Trade and Employment rather than for IASA. However, you know, we are monitoring them, and what we would like to see, I suppose, is evidence of the impact that these proposals would have on audit quality. The other significant proposal in that legislation is replacing the FRC with a new body called ARGA. Now, lots of the changes that are involved in that actually will make ARGA set up in a much more similar way to the way IAASA is already set up. So we're probably a little ahead of the curve on that. So another question there, which is the required set of accounts for the Companies Act, true and fair purposes, the paper-based set or the e-step? So this has been examined, and it is a matter of legislative interpretation, but we have been advised that your statutory financial statements, so these are your Companies Act financial statements, they are your e-step tagged financial statements, which means that they're required for audit. That's what you file with the Euronext Stock Exchange and also with the CRO. Next question, should Ireland now start looking more towards the EU and less to the UK in these areas? Yes, and I think, as I mentioned, historically there have been close links, and indeed the UK have been quite influential in Europe, but Ireland is very much aligned with the EU now, and not sort of automatically following what is happening in the UK. Okay. So I think that is all the questions then that are in for me. So I will pass you over then to Martin Kelly, who's going to talk to you about audit reports.
Good morning, everyone. This session will cover the long-form audit report, what the key sections are within it, what should auditors be doing to ensure that it is understandable, and what questions should the audit committee be asking around the audit report. I will also briefly talk about the audit report findings the authority has identified in the recent past and what impact, if any, they would have on the work of audit committees. To kick off the session, I have two Slido questions I would like you to answer. Do you read and understand all sections of the audit report? And secondly, do you find that the long-form audit report has led to increased understanding in the work of the auditor? I hope that audit committee members here today respond honestly to the first question. Given the volume of information that goes into audit committee packs, some sections can get glossed over, including standard sections of the audit report. So in today's session, I will give a high-level overview of those key sections. For the second question, do you find that the long-form audit report has led to increased understanding in the work of the auditor? That was certainly the intent of the long-form report, but again, when faced with a large body of text, the mindset can be, this is the auditor's own report and they are responsible for it. Also, some of the terminology can be intimidating for some committee members, especially if they're from a non-audit background. My key message today would be to ask the question to your auditor if you are unsure about any section of the audit report. So if we maybe move just to the responses now and see how truthful they were. So do you read and understand all sections of the audit report? A resounding yes there for 80%, which is very positive. We still have a number there, some honest members saying 4% said no. The second question, did you find that the long-form report has led to increased understanding? Certainly a more mixed bag here. 42% indicating that it did lead to increased understanding, but somewhat 36 and no 23. So hopefully what I'm going to talk about today might try and balance that out more in towards the yes category. Okay, if we move back to the slides. In the 17th of June 2016, the European regulation saw the introduction of the long-form audit opinion for PIs. It was introduced to make the information provided in the audit report more relevant to users. It was also hoped that it would allow for better dialogue between the auditor and those charged with governance, and also explain further the audit process and the audit work that was performed. So what are the key sections of the long-form audit report? I realise that most audit committee members are very familiar with these areas, so I won't go into too much detail, but I will try and give a short overview of each area with a particular focus on the CAMs, or the key audit matters. The opinion, the most important paragraph of the entire report, sets out the final opinion of the audit and whether or not the financial statements present a true and fair view of the company. Is it a clean opinion, or is the opinion qualified? The basis for opinion sets out the auditing standards under which the opinion is based. There is also an independent statement and the confirmation that the auditor believes the audit evidence obtained is sufficient and appropriate. Three key aspects of the long form report are the CAMs, or key audit matters, the statements on materiality, and scope. These requirements stem from Auditing Standards 701, Communications on Key Audit Matters. The CAMs set out the matters of most significance in the audit of the financial statements. They usually cover areas of higher risk of material misstatement, areas that require significant audit judgment, and significant events or transactions that have occurred in the period. The auditor is required to state why they are significant and how this was addressed within the audit. There are further requirements to provide a description of the significant risks of material misstatement, a summary of the auditor's responses, and any key observations. For materiality, I won't go into too much detail here, as one of my colleagues, Kieran, will cover materiality as it goes through the results of a recent materiality survey amongst audit committees and auditors. I will say that the materiality threshold and performance materiality threshold, the judgment made in determining materiality, must all be included in the report. An overview of the scope of the audit must also be included in the auditor's report. The going concern disclosure, that stems from a separate auditing standard, IASA 570. It requires auditors to include in the audit report a statement that the auditor has not identified a material uncertainty that may cast significant doubt on the entity's ability to continue as a going concern, a conclusion that management's use of the going concern basis of accounting is appropriate, an evaluation of how the auditor evaluated management's assessment of the entity's ability to continue as a going concern. For entities that applied the UK Corporate Governance Code and the Irish Corporate Governance Annex, to comment on the director's going concern statement in the director's report. And I suppose maybe just to caveat, this is all for audit opinions that where the basis of the opinion of going concern is appropriate. The responsibilities of management and those charged with governance detailed in the audit report is lifted straight from legislation and include the following. Management's responsibility for the preparation and fair presentation of the financial statements. Management's responsibility over internal controls, controls specific to the financial reporting. Requirements to assess the company's ability to continue as a going concern, and responsibility for overseeing the company's financial reporting process. Similarly, the auditor's responsibilities are straightforward. Obtain reasonable assurance on whether the financial statements as a whole are free from material misstatement, and also to issue an auditor's report that includes their opinion. There is some important terminology within the first bullet point. Reasonable assurance. It is a high level of assurance, but it is not a guarantee that an audit will detect material misstatement. And material misstatements, those misstatements which could influence the economic decisions of users. I think these distinctions are very important in the context of the wider public's perception of what an audit does. There is no certainty that an audit will detect fraud or error. Audit procedures are designed to identify material misstatements, but they're not infallible. What can auditors do with these sections to make audit reports more readable, more understandable, and more relevant? Given that the IAASA, the Accounting Auditing Standards and Company Law set out a number of key disclosures that cannot be omitted, a carte blanche approach cannot be taken. But these required disclosures themselves should not detract from the readability of audit reports. Clear, concise language is important, especially relating to items specific to the entity. The benefits of this cannot be understated. When we are dealing with sometimes complex areas with significant risk attached, the auditor should be trying to present this in as simple as possible terms. We've seen some good examples of the use of infographics when looking at scoping and materiality, and I will go through some examples now. This first is an extract explaining materiality as compared against one of the key reporting metrics, revenue. The extract comes from the audit report of a large building materials manufacturer and supplier. In this example, we have an extract from the audit report of another building materials manufacturer. This graphic explains the scoping coverage in terms of profit before interest and tax, revenue, and also total assets. In 2020, we published a thematic review on ISA 701, the ISA relating to CAMS, which looked at the reporting of CAMS in 22 PI audit reports across multiple industries. Some of the points I will now talk about stem from this thematic review. I'll start with some key questions for the audit committee or the auditor. How many CAMs should there be? This is entirely the judgment of the auditor. The thematic review saw between 1 and 8, depending on the industry and sector. Is the CAM sufficiently granular, and does it contain any generic language, especially around the description of the risk? Are the key observations of the auditor also specific to the risk? Moving on to IASA inspections, 44 findings were identified in relation to audit reports over the past number of years. In relation to CAMS, the findings included the stated work performed did not describe the actual work performed. So audit procedures were either not performed or performed in a different manner. Including CAMS in the audit report that were not in the report to those charged with governance, i.e. the additional report. Again, it goes to understandability and consistency. Non-identification of a significant matter which may or should have been reported as a CAM. Not including references to relevant financial disclosures in the CAM. This is at the lesser end of a finding, but nonetheless still a breach from an accounting or auditing standards perspective. The following are more general findings in respect of the audit report. Audit work undertaken that does not support statements made in the audit report, especially the statement that the financial statements are prepared in accordance with the applicable financial reporting framework. In many cases, we identified insufficient audit procedures to make that determination, or we identified clear gaps in IFRS disclosure requirements that were not addressed. Not having the required disclosures in the audit report as required by auditing standards or company law, a template by the audit firm would have addressed this. Some of the more serious or more basic findings identified were the backdating of an audit report, the incorrect name of the entity on the audit report, and finally the date of initial appointment not being correct. So what are the key questions audit committees should be asking their auditor? Have the CAMs been satisfactorily explained to the audit committee? Did the audit committee challenge on whether the CAMs presented in the audit report or the draft audit report were the most appropriate? These are the auditor's key audit matters, but you should, as audit committee members, be comfortable with their completeness. Is the audit opinion consistent with the additional report to the audit committee? Do I understand the basis of materiality and or has the auditor clearly explained it to me? The long form report is not, as I've heard it described, more supplementary text that the auditors can cover themselves with. I don't believe that is the purpose, and when well written, or well-crafted, a long-form audit report can provide good insight into the work performed by the auditor. I recently gave a talk to one of the audit firms as part of their audit quality training workshops. The question was asked on how audit committees assess audit quality and the degree of challenge presented to the auditor on their audit. Auditors, for the most part, want to be challenged on their work. They see it as an integral part of the process, and it keeps them focused on the key risks and issues. The audit report is the key document that the auditor produces. So I would encourage you all today to revisit the audit report and to challenge your auditors on what is contained within, and also to ensure that all areas are satisfactorily explained to you. In this slide, I've included links to the following auditing standards for any that have an inclination or need a technical point of reference for audit reports. So thank you for your attention. At this point, I think we can move across to Slido and see if there are any questions being posed. First question, see there, are CAMs required or going to be required for companies that are not PIs? The short answer is no. I think that's really a matter of judgment between the audit committee and the auditor themselves. It's certainly not a one size fits all. The introduction of CAMs into non-PI companies' audit opinions. If it would again aid to readability, understandability of the audit work done, absolutely, but I think it's a consideration for the auditor and the audit committee. Do we, audit committees, have responsibility in relation to CAMs? Consideration of what should be included as a CAM and what shouldn't. Again, as I alluded to in the presentation, no, you don't have a responsibility. It is the auditor's audit report, but certainly you should have the discussion with the auditor on what CAMs are included, what CAMs are, or if you believe that another CAM should be included or key audit matter, why is it not being included? And I think that conversation is very important. Can you explain what action IAASA takes where they see breaches that it noted in the auditor report? Maybe I'll just talk about from the perspective of an inspection. As part of any of the audit work that we would inspect, if we identify an issue in the audit report, depending on the severity of the issue, it could be deemed a finding and it would make its way into the inspection report to that audit firm on that particular audit that would have been carried out. So again, it depends on the severity of the issue identified in the audit report. Again, if it was at the very severe end and if there was a fundamental issue, that could potentially lead to an enforcement action. But again, I suppose it would want to be fairly severe. Does IAASA think there's an ideal number of CAMs? Again, I suppose I'll let you reflect on the slides later. What I did say was there isn't an ideal number. It completely depends on the industry, and it depends on the complexity of the entity itself. So as I said, we saw between 1 and 8, but for example, some of the regulated industries, you would see a higher number of CAMs because there's higher numbers of significant risks identified or critical areas that the audit team would be looking at. What would be required in the audit report as regards ESEF? As far as I'm aware, the tagging will be the very same as all of the other areas of the audit report, of the financial statements. So there will be, my understanding currently is that it is the intention that the audit report will be tagged. I think that is all the questions that I see. So thank you very much again, and I will hand you over to Kevin for the next session.
Great. Thank you, Martin. Well, we're slightly ahead of time, but I think that gives us a bit of a broader opportunity for what I hope will be a very interesting session with my colleagues here on our panel. So I might actually start with the 3 Slido questions that you'll see on your screens there. That are relevant in the context of the discussion, and we'll discuss your answers to them, hopefully, throughout the session. The first question is, how do you rate the quality of written audit communications you receive from your auditor, and are there any areas you'd like more information on? Second one is, do you believe the statutory audit should be more forward-looking, as well as focus on the financial statements? And the final one is what do you know about CSRD? And there's a clue there. It's the Corporate Sustainability Reporting Directive, so that'll give you a start. And as I said, we'll come back to those throughout the session. So while you're putting in your answers to those, I will introduce you to the panel members here. So on my far left is Emer McGrath. She's audit partner in KPMG, specialising in life science, technology and aviation. I have Donal Courtney, experienced audit committee chair with PTSB, Dell Bank International, UniCredit Bank Ireland and IPUT. Then I have Mary Fulton. Mary, very experienced INET as well, Allianz Global Life, Hanover Re, Bupa Global, James Place International, and a long experience in audit before she moved into her audit committee experience. And Colin Feely. Colin Feely's head of financial services audit with GT. So we've a wealth of experience here. And as was indicated in the answers to what people expect, I think hopefully we're going to get an awful lot from this session, and you will too. Okay, so turning to the first Slido question, perhaps, where we asked about the quality of written auditor communications, and are there any areas you'd like more information on? Well, it's great to see that the biggest word we're seeing there is excellent, and there's a very small confusing word there. Good is now overtaking excellent, so I think maybe people are getting a bit braver. So, there is a lot of information in audit reports, and indeed the session you just heard has Martin set out quite well some of the challenges both for auditors in crafting audit reports, as well as for audit committees and other stakeholders in terms of being able to read them. Way too long, I see there. And again, that's a real challenge. Martin talked about the number of CAMs, for example, and that obviously can lengthen an audit report. But equally, there are more and more statutory disclosures now that are required. And that is auditors explaining what they do. Which is very useful information, but equally one can understand that some readers will feel, well, that's just a lot of stuff that auditors are saying, but doesn't really provide any information. Some would like to see written reports at the close of audit meetings and bullet points. And that goes to communication as well, more broadly between auditors and audit committees, and what I suppose constitutes good communication. And I think that's probably maybe a good point to sort of open this to the panel. So clearly the level of communications will always depend on the size and nature of a reported entity. And putting that to one side, you can have good communications, you can have bad communications, places maybe where it falls short. But before we get into the qualitative elements, perhaps if I could ask Emer just maybe to take us through what auditors are required to communicate, and what you think are the most important messages that you need to convey within those prescribed communications.
Sure, thanks, Kevin. Well, as you mentioned there, and I think Martin has taken us through the long form report, which marries very well with what we have to do under the IAASA, which is communicate things like the scope of our audit strategy, what resources we've allocated to it, and also our materiality. But maybe if I just picked out some of the critical areas, I think the first area, and we've focused on it already in the session earlier, is that piece around our communication of the key audit matters that ultimately find their way into that public opinion, which the audit committee here, the members will be all very familiar. And I suppose from the auditor's perspective, the most important bit is that we give extra colour to the audit committee and help them understand exactly what the nature of the work we did. Really, these areas are the most important, the piece that takes significant audit effort. We need to convey to the audit committee members so they understand exactly what we did on things like estimates and judgments and key assumptions, how we got behind those assumptions and how we audited them, so that the audit committee can be comfortable that we have done sufficient audit work. And I suppose then the second piece I'd turn to is that piece that came up earlier in the session about what can the audit committees themselves do in terms of that communication piece with us as auditors. And I think the really critical piece here is that the audit committee members challenge the auditors on either those key audit matters or on our risk assessment. And oftentimes, like I was in an audit committee recently where we had a really, really good debate about something was a significant risk in the prior year. Why has it been downgraded this year? Audit risk and risk assessment is dynamic. And just because a number might be still materially big in a set of financial statements, it doesn't mean that the risk level is the same, because facts and circumstances like an intangible asset or something, it mightn't be as hard to audit. Things might have moved on. So I think the onus is on the audit committee to challenge us back. And I think that leads to very, very good debate and to a better outcome and a better understanding overall. And maybe, Kevin, the last point I'd touch on, and it kind of comes into a bit that Lisa was talking about earlier, that piece about expectation gap and the need for the auditor to be really, really clear in what's within the scope of our audit and what maybe isn't. An example of this is internal controls. So sometimes you can find that an audit committee might have an expectation that we have tested audit control, internal controls at the client, and we might have or we might not. But I think we just need to make that crystal clear. Currently our audit report under IAASA does not opine on controls. We can choose to take a control approach, but again, I think, and you can see there's debate in the UK, etc., as to whether we might need to do this in the future. But for now, we don't, and I think that's maybe a few of the key areas that we need to focus on.
Okay, I think one of the key points actually I think you draw out there is auditors know what they're talking about, but there is an onus on them to explain that maybe the nuts and bolts of the audit to the audit committee. And of course, audit committees change. You can get new members on audit committees who might necessarily know what everybody else knows. So that communication element is very important. That's great. Thanks, Emer. Maybe Colin, if I could maybe throw the same question over to you. Do you have any other sort of further points?
I suppose, Emer has touched on some of the critical factors that, form part of our day-to-day roles and jobs. Materiality for me is something that sometimes we need to spend a bit of time upon. Certainly the criteria for assessment and the calculation of that. And oftentimes the number of the quantum of the trivial element of materiality, audit committees need to be comfortable that anything below that number may not come to their attention, and it's something that I think audit committees need to reflect on. Another item would be in relation to the audit findings. Oftentimes, audit findings focus exclusively on numbers. And we can be asked for, our qualitative views in relation to policies, procedures, estimates, and disclosures. Every year when we have, the formal report that we bring to those charged with governance, there may be items from the previous year that were open. We need to highlight if they are still open, have they been closed, how they were closed, and is everybody happy that they were closed on a satisfactory basis. That also adds to kind of bridge one audit cycle to another, and it might form part of that audit expectation gap, which you will bring up at a later stage. And then finally, for me, the independence piece is critical in everything that we do, and oftentimes it can be further on in the formal documentation that we bring to audit committees. But there can be good conversations around independence, particularly where there are non-audit services, or where perhaps something in a network firm was rejected or declined. The audit committee may not be aware of it, and sometimes a general discussion can follow, which I think is useful for everybody in the room.
Okay, thanks. So what we're getting into maybe there is actually as much the qualitative aspects as the numbers that really all the parties need to discuss. So I think that's a key message. All right. Maybe if I could turn then to our audit committee guests and maybe Donald first, if I could. So, we've talked about what's necessary, but in terms of quality communication, what do you consider to be the attributes of quality communication, and I suppose what pitfalls have you encountered with auditor communication? Where has it gone wrong?
Yeah, I mean, if I look at the three boards that I sit on currently, I very much take the view that I look at the process as a team thing, and within that, I look at three teams. You've got the internal finance team, you've got the audit committee team, and then you've effectively got the audit team itself. So for me, communication between those three teams is absolutely key, and the earlier the better in the process. So, I would see those three teams, discussing things like changes in products, changes in markets, new accounting standards, new auditing standards, and basically, looking at those and discussing them and getting those issues out on the table at an early stage right throughout the process. One of the things I think is key for organizations is to focus on the quality of their own internal accounting memos and their own discussions around what positions they're taking on various accounting standards, what the assumptions are, etc., so that they're brought to the audit committee and a fulsome discussion is had around that. And one of the key things for me as well is and it happens in all the boards I sit on, is auditor attendance at audit committee meetings, where they can hear what's being said, they can challenge what's being said, we can challenge them. So all of that goes to me to very good communication. So the final product at the end of the year, for me, really is facilitated by good early communication among those three teams, effectively acting as one team. Effectively, we all have different responsibilities, but we're in the same boat, rowing in the same direction.
Okay, so we're actually talking about three-way communication then, and as early as possible.
Yeah.
And in fact, you're throwing a challenge then really to finance function about the quality of its communication.
Absolutely.
Okay, maybe again, Mary, and thanks again for joining us, Mary. Maybe the same question to you around, quality communication and where you think maybe auditors have challenges from time to time.
Yeah, I mean, maybe just to pick up on some of the points that Donald made around communication and timely communication. I mean, a key part of that are some of the practical things to actually make sure that people have enough time to consider in detail the more complex areas. And I think often there's a great pressure at the year end on reporting and so on. So I think, again, going back to all three parties that are involved, the more that can be done in a practical way to front load consideration of the bigger key judgments, the estimates and so on, and get those out there before the year end, because COVID happening in mid-March was a bit unusual. That normally normally don't have a big issue like that turning up at that time. But typically, the bigger, more contentious or debatable issues are well known in advance, and they should be got out there early on with papers that set out, the basis that management is using, the statistical support for maybe whatever judgments they're making and so on. And I think if that's done well, it gives the audit committee and the auditors time to fully consider. I think the finance function are important where there's discussion between, clearly auditors will raise any concerns they have or any points with the finance function as they happen. And I think a finance function where the CFO actually communicates, say, with the audit committee chair, in an informal way to say, look, these are the topics that are being discussed, here's where we are with them. I think that brings the audit committee along the journey rather than presenting them maybe with a fait accompli, in the middle of reporting season, and it'd be more difficult to address at that point. And there are practical things to be done, like, for example, it may be obvious, but if there's a big change in accounting standards, get pro forma accounts done before the year end. Everybody can see what the layout changes are, what the disclosures might be, and so on, so that you're not debating those things which could have been done, earlier, at a time when everybody's under pressure and you're trying to get to the critical pieces. So I think it is a three-way job, and it's important that everybody gets involved.
Okay, and let's say we're coming up to, or we're 31 December this year is sort of coming into view. I mean, are you thinking audit committee should be starting those discussions now, or is it still a little bit too early, do you think?
Oh no, absolutely. I would expect for many of the key estimates, there's not that much that's going to change in many businesses between now and the end of the year. So I would have expected that that the audit committees that are happening in, say, October and November those issues are already being flagged. And as Donald said, the way the company prepares, the finance function prepares its papers to articulate those, I think is important. And I can get a lot of that kind of issue out and debated in a timely way, with full consideration, as I say, rather than doing it, after year end.
Okay, great. So I think that's a bit of a heads up for audit committees and finance functions out there to get moving if you haven't got moving already. Colin, if I could just maybe then turn to you and get the sort of the auditor's perspective on that good practice in auditor communications. I suppose what advice you would give to audit committees when they're reading auditor communications, and sort of what areas to focus on.
Yeah, and I think, the main document at the end of the audit tends to be around the audit results report. And oftentimes there'll be sections contained within that in terms of the key risks and the procedures around the CAMs. There may be comments, observations or findings. I think it's worthwhile the audit committee spending time in relation to understanding those, having some dialogue around them, feeling free to ask questions at the final audit committee meeting. I also think, and I've mentioned it already, in relation to the open items coming forward from the previous year, because that can interplay into the current year, and it's important that people satisfy themselves in relation to that being dealt with satisfactorily. The dialogue and the rapport between the chair of the audit committee and the audit partner is important. I think open dialogue, early dialogue, it's good practice, it's good administration. And if there is, as Mary has mentioned, if there's something that needs to be got out into the open early, the earlier it's out, the better, because that puts us all in a better position. Nobody likes surprises in this world. And if we can get ahead of that, that's something worthwhile doing. So for me, and on a personal level, I think that dialogue between the chair of the audit committee, the actual audit committee itself, having the freedom to ask questions in a dynamic environment. People mightn't always know the answers there and then, but at least there's an understanding of where mindsets are headed.
Okay. And I mean, dialogue implies two-way.
Yeah, absolutely.
So obviously, the auditors, if I can say it, maybe sometimes are speaking from a position of strength. Obviously, they know their subject. I mean, do you think, there's good dialogue in audit committees generally in Ireland? Are you getting the sort of feedback you'd like to, or do you think sometimes it might be a challenge for audit committee members to engage?
They differ, and it depends a lot in the present day in how the constitution of an audit committee has come together. Different disciplines, different backgrounds, different experiences. And that open dialogue is something that varies from one committee to the next.
Okay. That's great. Thanks. Well, a key I'm taking from that is good communication, is early communication, and that definitely allows everything to move a lot more freely when you get to the busy end, as Mary referred to. So that's great. Thanks. We might move then to the second question on our Slido, which related to the statutory audit and whether people felt it should be just backward looking or whether it should be forward looking as well. So yes, I can see is ahead of no there. That being said, I see no, it would be very difficult. I presume the auditors would underscore that. And I think there's a very relevant point there, yes, but there needs to be a clear framework. Absolutely. I think if there's going to be consistency in audit reports, then auditors need to be very clear about what they're reporting on and what's the basis for that reporting. And again, the word challenging appears there as well. And then a comment, I think it is forward-looking. And I think there is absolutely elements of the audit report, if you're, again, the auditors can speak to this, but if there's elements of the audit report that oversees valuation, for example, and going concern, I suppose, is another very good example, whereby, you have to be forward looking to make a report at a point in time. So I think, that's all very useful. And I suppose that leads us into the area of the expectation gap. And, this, which has many different aspects, but we're going to try and focus on maybe the expectation gap for audit committees and the gaps there is between what auditors do and what audit committees perhaps would like. So again, if I could start with Emer on this one, what do you think are the key messages that would help an understanding of what audit actually does and what steps maybe auditors can take to reduce that expectation gap?
Thanks, Kevin. Well, I'm glad you have ring-fenced the question to the expectation gap between the auditors and the audit committee, and not the wider piece about investor shareholders and the public at large, or we'd be here probably for the whole day. But maybe just to hone in on a few things on that, clearly from the auditor perspective, I think the single most important thing we need to do is clear and concise, plain English language. Just make it simple. It came up earlier about use bullet points, articulate our points clearly and get it across. That's the number one objective. The second piece, and it has been talked about this morning, it's been talked about on the panel, Mary, Donal, about that three-way communication. And I think that's vitally important. So that's the piece about, say, for example, an area of key estimates and judgment and doing it early. What works really well on a committee, on a client of mine, is the finance team actually each quarter organise a pre-audit committee meeting with just the chair now of the audit committee, not the whole audit committee, but they take through their position on those kind of key estimates and judgments or anything wrinkly or knotty that's going to come up towards the year end. So they do it proactively. We participate, we intend, we have good dialogue, good debate. So the issue is kind of aired before it gets to formal committee. And I think that's just a super helpful idea that maybe people could take away today. Another thing that was mentioned, that piece, and again, it's like this is all common sense stuff, but it is so important. If there's a new accounting pronouncement or something, a new auditing standard that we have to grapple with, just have the debate early. Don't leave it to the last minute. At KPMG, we love to go with the premise that we say it's a no surprises audit. I'm sure that's tripped out everywhere, but it's so true. The earlier you can do it, the better. And I think just one last thing, Kevin, to say in terms of that old bit, I think what audit committees are going to see, they're probably seeing a feature of it now, maybe in some industries like things that rely on actuarial reports or valuations. I think there is going to be an uptake in the number of subject matter experts and specialists that might have to attend an audit committee. And I think the onus is on us as auditors to explain, A, why they're there and why we need expertise. And what we've been touching on earlier, that whole piece about sustainability reporting, I think it's going to become a feature. So again, clear communication and bringing those people into the wider audit committee, because auditing has gotten more complicated in the recent past. So, and we do need help from these specialists.
Yeah, and I think we've heard that a couple of times now. I think the potential benefits of a meeting between the audit committee chair and the audit partner or the audit team before we get into the wider meeting, and I think that's very good. I might just pick up on one point there, because you talked at the start, and I'd agree. I think if you can get clear and concise, if you can get as close to plain English as possible, that would be very good. But at the same time, then we're bringing in subject matter experts. We're getting into technical areas. I mean, do you think the auditor has a role in sort of playing a translation service perhaps between those technical experts and the audit committee, or would you expect the audit committee to know their area because it's their business?
No, and even just one further layer on that, Kevin, is as an auditor, I can't outsource to a subject matter expert. I am signing the opinion, so I have to take responsibility and I have to understand it. And I do think that, and again, I think it's explained, as somebody said, it depends on how the audit committee has been generated. Some people have, industry expertise in that particular area, some mightn't. So it is important that you just, you hone in on what's really important and you explain it well. Yeah, absolutely.
Okay, great. Thank you. So maybe Mary, if we can look at it from the audit committee point of view, I mean, what role do you think the audit committee takes then in responding or addressing that sort of audit expectations gap?
Yeah, I mean, it's an interesting one to say, auditors should make things simple, plain English and so on. And I have some sympathy because I used to be one, but obviously the audit process is underpinned by standards. And those standards are technical and language is precisely defined in those standards. And that's useful because then everybody knows exactly what that means because it's defined. If you depart from that, it does create potential problems. So I think there is that dilemma between using the technically precise language and explaining to an informed public, but it is an informed public, the audit committee, what exactly is being done. So I just think that is a challenge, and often the audit committee chair who may be the person with financial experience can maybe facilitate that. I mean, one area I think, and Emer referred to it earlier, is materiality. And you do see debates about materiality at audit committees, and audit committees will challenge. I think often what happens is the auditor will come back to say, well, that's our benchmark around revenue, or whatever the factor is. That's our view. And it's hard to dig below that. And to say, well, why is 1% of revenue the number? Give me an understanding of that. Now, it does relate back to the users and how they make decisions around the financial statements, but I think that link could be better explained. And the other area, I think, where the whole area of internal controls is clearly one. I think particularly the work done around IT controls. I think most audit committees probably don't fully grasp what auditors do and don't do around IT controls. And I think that's an area where there could be, I've seen very good explanations of precisely what happens. Do audit committees fully understand what the implications of the work that's done and the work that isn't done is? And I think that's an area for development.
Yeah, I suppose, and again, we've had reference to that already from Emer, I suppose, this area around internal controls and maybe an audit committee getting lulled into a sense of security because they're hearing the auditor talking about internal controls and then perhaps feeling that the work is done. I might just actually ask you a little bit on that materiality question, because it does come up from time to time, and it's going to come up elsewhere in this morning's session. And again, Mary, you would have the advantage of having seen both sides of it. But do you think that's a challenge for auditors to talk a bit about materiality and what it means and how they've got there?
Emer could comment. I think most auditors could talk about materiality for all day if you want to, but I think it's explaining why they've come to that decision, and I think audit committees would find it useful, because typically, in my understanding, most auditors will look at several. Colin could come in here, but you look at several different metrics, and then why do you pick one and how do you combine them? And there is an element of judgment involved, but just how you do it, I think that is a useful discussion.
And I think maybe just to take the area that I kind of have a concentration in will be in the insurance side. So the regulator is looking in and has a focus in relation to solvency. So net assets is something that we hone in on in terms of a percentage of net assets, because if there's a differential there, that's going to cause a blip in solvency. So that's an easier one maybe to explain. But I take the point in terms of, revenue, 1% of revenue. It can sometimes be difficult to explain it.
Yeah. And I suppose in that financial services area, your audit committees would probably tend to come from a group of people who would know the language of central bank regulation and things like that. That's great. Thanks. And maybe Donald, then, if I could turn to you, and again, just on this whole expectations gap area, and where do you think some of the challenges are and what audit committees can do about it?
Yeah, just honing back on your conversation there around internal control environment, I think we probably don't do enough as audit committees in really understanding the enterprise-wide control environment. And what do I mean by that? If you look at the banking or financial services industry, when we look at the various sort of 3 lines of defense model, we have, the first line, which is really the business owning risks and owning controls and testing and reporting. And then you have a second line, which is really responsible for implementation of risk frameworks, etc., but also do testing and reporting. And then you've got the internal audit function as the third line, which again does its risk assessment and does its testing and reporting. But it's something we started to do in some of the boards I'm now at the moment, is actually taking all three of those and all of the reports and really looking at the heart of where we are in terms of our internal control environment, and trying to understand then how we can, use that information to discuss with external auditors in terms of what's material, what's not material. Have we a bunch of, we talked earlier around last year's audit points being cleared or not cleared, but, also we need to look at the various attitudes within the organisation for clearing all the various points that are being raised in terms of self-testing, in terms of internal audit testing and so on. So when you get all of that sort of deep information, it gives you a really good indication of where we are in terms of the internal control environment. That then helps us discussing with our external auditors, but it also helps us in terms of framing our own opinions on things like corporate governance code compliance, or, with the central bank or the UK for listed companies. So I just think that we need to do more around looking around the enterprise-wide control environment and really getting a handle on that and what impacts that has within our organisations.
And you talked there also about having a discussion with the auditors, using the outcome of those reviews. I mean, when do those take place? Do they take place, do you think, before the audit commences? And are they sort of around perhaps shaping how the auditor, assisting the auditor in shaping how the audit will take place in terms of what work they'll do on internal?
Yeah, I think it's really around, so all of the internal audits are all available, all of the RCSA testing is all available, etc. All of that information, if it's discussed at an audit committee in sufficient detail, the auditors will be attending. That will give them indications as to where there might be weaknesses and controls, where maybe they might start focusing their audit work as well. And it's really then in the period, if you've got a March year end, December year end, it's really in that period, September, October, November, pinning down where those key issues are and whether it has an impact on additional work that the auditors may need to do, whether it has an impact on whether we can say that we're compliant with various corporate governance codes. So those discussions really should be on an ongoing basis.
Okay. I might ask you just briefly to comment on one more aspect, Donald, of the expectation gap, and I suppose the area around fraud, and maybe audit committees' expectations, if I can use that word again, of what auditors can do in that area, because it's challenging for everybody.
Yeah, look, it's challenging for everybody, and we're all aware of the various sort of comments that have been made over the years in terms of whether auditors should be made more responsible for fraud detection or whatever. And there's obviously various proposals in the UK, and we'll see what comes out of them. But I do think it's important that, getting back to the control environment comments, that that individual organisations take responsibility for fraud detection themselves, and that they really do have a good internal control environment that allows them to identify fraud. I mean, we know fraud can be internal, it can be external, it can be small, it can be large, but really it's all around trying to identify those frauds, reporting those frauds, because there will be responsibilities potentially within annual reports or indeed to authorities. But it's really trying to get a handle on why they're happening and then take the lessons learned from that and then, bed those in and maybe additional controls as well. So, rather than looking outwardly at auditors, I think it's important that organisations look inwardly and control that themselves as well.
Yeah, and of course, from time to time, fraud can happen at the very top of an organisation, and controls can be circumvented, and that's a particular challenge and a particular difficulty. But thanks for that, Donald.
Yeah.
Emer, we've heard a couple of comments there around what's happening in the UK and some of the discussion that's happening maybe coming out of the Bryden Review. I mean, one of the interesting discussions or suggestions that came out was around redefining the concept of audit, and whether audit should move away from being purely accounting and into something else. But I suppose maybe taking that and more broadly, what do you see are the fundamental changes for statutory audit over the coming years?
Yeah, and I think I wouldn't necessarily advocate to follow the UK approach blindly here in Ireland. I think where we sit now, I know historically in the past we've been closely aligned with them with accounting standard setting, etc. But probably the EU position is way more important to us, and to stay in step with that, particularly from a competitive point of view with Luxembourg, Frankfurt, etc., particularly for our financial services companies. I think there are some interesting parts in the UK debate up that are worth thinking about, and probably the first one, mind you, if you read the paper yesterday, they'd say it's probably not going to be a runner, is the whole concept of SOX, internal controls for UK and obviously an Irish company then, if we were to go down that path. And I would say SOX, I live in a SOX environment, so a lot of my clients are in that space. And the relative experience in the US, there hasn't been any kind of shock corporate failures, since it came in. Now there's the whole debate about the absolute time it takes for a company to get it up and running and the level of precision you need in the controls. But there probably is something in it. And it's a bit like Donal was talking about that. For an audit committee, from an audit committee's perspective, that interplay between understanding the wider piece, be it the control environment, even the enterprise risk management piece, and then the financial statement audit. So there is something there in that, Kevin, I'd say. That piece about, separation, audit firm separation. And I think the risk with that, and we touched on it earlier, an audit has become a much more technical beast over the last while, and we rely on our specialists, our experts within the firm. And it's much easier when they're in the same firm as you and you can rely on them. You're all singing from the same hymn sheet. I actually think it might have an adverse effect on quality were we to be separated and you're having to go externally to get that specialist resource. So not sure about that one. Just switching then to the wider piece about where I think the future of audit will go, or even what we're seeing now. Data analytics, hugely important. We're becoming, our clients are becoming much more complicated. Systems are becoming better. Mary mentioned about the ability to audit IT controls. All of that is hugely important. So I definitely think there's more to come to pass there. And again, just that piece about, I suppose, the financial statements themselves becoming probably less a set of just numbers and more, the narrative, the sustainability piece. I think that there's huge change going to probably drive change in audit at some respect, just because momentum is changing. And we will ultimately, when it comes to sustainability, et cetera, there's probably a role there once it gets hammered out in terms of us doing procedures over that kind of, I'll call it non-financial information. So there is change, and there is change afoot.
Yes, you referred there to some of the recent debate around SOX in the UK. I think that came down to cost, did it? I was reading it pretty bluntly yesterday, but
I think so, yeah. And I do know, because I was in the US in 2004 at the start of SOX implementation over there in poor companies, the amount of resource they had to put into it. But if you talk to anyone in the environment, once it gets embedded, once it becomes part of the nuts and bolts, it does lead to, to good outcomes in terms of managing controls and reporting.
Okay. And just to take you up on one other point, which was data analytics, and been hearing an awful lot about it for quite some time now. Is it yet part and parcel of audit, or is it still a little bit of a cherry on top?
It is difficult, Kevin, because we have to do our audit within the auditing standards. So it is, in terms of being able to rely exclusively, it is good for reporting and communication, but to be able to actually satisfy your audit steps per the auditing standards is difficult, so I think more will have to change there. Yeah.
I'd probably tend to agree on that. There's work in the standards area as well, in fairness, as well as for auditors to try and marry the two together. Okay, thank you. Might move on then to the annual report, having solved the problem of the expectations gap. So maybe, Donal, turning to you. So, we're at a stage now where maybe we might be doing first drafts, or we might be considering that sort of thing. So if you're looking at the annual report, what are the key risks do you see for the audit committee in the sort of annual report as a whole?
So I guess the key issue is we don't want to miss anything. So therefore, we've got to make sure that we are well aligned in terms of what we're doing throughout the year. And I think we've talked about it earlier on. There's 3 teams involved. I think we've got to we need a very good timetable in terms of when we're looking at things. So for instance, last year we had changes in auditing standards around going concern. So that was something that we had to deal with early. I think it's really important that we get any changes that are coming through in terms of an annual report have got to be sort of socialized. I think Colin mentioned it earlier in terms of discussions between audit teams, between finance teams, and maybe even impromptu audit committee meetings to really sort of work through some changes, and that might be in September, October. I've done that in the last couple of years, where we get a really good line of sight of what the annual report is going to look like. We look at disclosures, and we have additional meetings to try and make sure that we're addressing those issues. going back to the point around key internal memos, it's really important that organisations themselves look inwardly and make sure that they have the right memos, that they have the right backup, the right support to be able to take positions, that we discuss those at the audit committee, and that the auditor is at those meetings, so that again everything's out on the table. There may well be issues that arise late on, but I think it's all around making sure that we're planning and that the three teams effectively are working together to get the product to a state where, you know, we don't have last minute issues, or that we allow ourselves time to deal with issues that come up at the very end.
If I can maybe just push back slightly on that and maybe challenge just on the area of how early you do communicate with auditors, because, you know, obviously there will be challenging issues and the finance function will be aware of challenging issues and they'll know where there might be a bit of eyeballing across the table. I mean, in your experience, does that happen? Do you sit down with the auditors around now and say, look, we know this is going to be an issue in January, February when you're in?
Absolutely, yeah. I mean, I would say that the board cycles that I'm on, a couple of them are quarterly, some of them are monthly. I would say September, October, November are very busy periods for that type of discussion. Some years you may have some, other years you may not have. But I think all of I really encourage and meet with the CFOs and the audit partners on even outside of meetings. I think we talked about that earlier, to try and understand, you know, how are we going to deal with certain issues. So I have one at the moment in one of the institutions around some of the requirements for regulatory definitions in terms of default, etc. So what we've had to do is sit down, go through it, identify what we can do, look at the regulations, and then basically sit down with the auditors and decide how are we going to deal with this. They may not be able to say, here's your answer today, but the work is planned so that when we have our next audit committee meeting in December, we will get an answer in terms of where we feel we are. So again, that's front-loaded work that can and should be done earlier than maybe leaving it to later on in the stage.
Okay, that's great. So again, a theme we're hearing repeatedly is that whole around early communication. And again, I think that responsibility on the organisation to have, you know, an internal timetable that's sort of working out itself, its positions, and having those papers for the audit committee, so that when the auditors arrive, you know, around this time of year, that you can have that sort of mature conversation about the challenges.
Yeah, and I think as well, CFOs will be discussing with audit partners, so, you know, outside of meetings, and there will be positions being developed. They don't have to be through a formal meeting, but obviously the decisions ultimately will be made at a formal meeting. But all of that type of work is essential, I believe, in getting to the right answer in the appropriate time.
Okay, thanks. So Colin, if I could turn to you from the auditor's perspective, and, you know, obviously by the time when the auditors are getting in and doing their work, I mean, now we're looking at the finalisation of the audit report. I mean, what areas do you think, or what advice would you give to audit committees in terms of critical focus as part of that finalisation of the audit report?
Yeah, I think Donald hit the nail on the head there in terms of that last comment, the informal dialogue between some of the management team, the CFO, that goes on, you know, just as night follows day, and positions are aired and comments are aired. That doesn't need to be in that formal area. That's critical in terms of moving forward. The timetable is the be all and end all. Time is dynamic. Once it's gone, it's gone. You can't get it back. And we're all under pressure. So a clear timetable early in the process helps everybody and gives everybody an easier life. The stakeholders in the process, you know, it's the audit committee, it's the board, it's the internal management, it's the auditors and the audit teams. And they all have to have a mechanism in terms of how comments are fed back to a central point, how that whole administration function is managed, how discussions take place, how positions are ironed out, or, you know, differences of opinion are ironed out. So that whole dialogue is hugely critical. And ever since I kind of started in this profession, somebody said to me, you know, administration is a huge part of the job. And this is one aspect of it that's very important. And let's face it, the annual report is our shop window, or is the shop window. And it's worthwhile spending time on it and making sure that it's presented as well as it possibly can. Another little kind of thing that's starting to develop in the present day, annual reports are becoming more voluminous. They're getting longer, more pages. And this concept of the front of the book and the back of the book is something that is more prevalent. So energy that's evident at the start of the annual report needs to be evident at the back of the annual report. So, comments in relation to, judgments and certain, estimates or policies and procedures need to follow through in terms of the narrative of footnotes to detailed notes in the financial statements. That's important, and something that, with the best will in the world, fatigue kicks in, particularly when you're dealing with, numerous drafts, that it's important that the energy stays consistent right throughout. Emer touched on the point there of, additional responsibilities coming to the fore, additional narrative information being required. There's an onus on us as auditors to have additional SME resource with capability to, consider various excerpts that go into the annual report. But likewise, the audit committee need to have people on their side who are proficient in understanding what that information is saying, and saying to the external audience, the stakeholders, and anybody who uses the financial statements. And then I suppose a final point would be, clear disclosure on things like, risks, judgments, post-balance sheet events, all these kind of material items that people look for in financial statements. Again, we could talk for a long time in relation to annual reports.
Yeah. You mentioned SME there. That's the specialist people who are involved that Emer referred to earlier on. Just to try briefly on the front end versus back end, I mean, what we are also seeing, I suppose, is increasing auditor responsibility for other parts of the annual report, and increasing regulatory oversight and regulatory requirements in respect of other elements of the annual report. And that's everything from sort of alternative performance measures that could be in there, but definitely as we start moving into sustainability reporting, which we'll talk about shortly, all of that really means that what used to be called the glossy end now really needs to sort of hit the nail, and the auditors will be checking that.
Yeah, and we need to be, able to consider all that information, understand it, comprehend it, and ultimately, aspects of it will form part of our opinions.
Okay, that's great. Thanks, Colin. Well, that leads us nicely into our third question on Slido, which hopefully we'll be able to call up there, which was asking for people's knowledge of the Corporate Sustainability Reporting Directive. And people are getting more honest as they get more relaxed in the morning, which is good. Not enough, I think, is probably true of all of us, including, I suspect, some people in the Commission. These things are moving very, very quickly, but obviously we hope to hear a little bit more from one of our later speakers. Learning about it. And I think that's the key at the moment. It's not a fixed thing, but I think we can definitely get a sense of the direction of where CSRD is going. And there are, if I can use the phrase, some red lines that appear to be in the proposals that I don't think are going to be changed. Will be on top of the agenda in the near future. Probably needs to be on top of the agenda probably now rather than in the near future, if you look at some of the deadlines. And looking forward to learning more. Expensive, well, we'll see. I think it could be expensive either way, whether you do or you don't. So, just you need to sort of gird yourself. It's a little bit like the socks reference that Emer made. This is going to become business as usual. So we'd better all get used to it. But they're interesting. So thanks for everybody for your input into that. So CSRD is one of I suppose a number of far-reaching changes that we're going to see over the next year or two. There's also ESEF, which is finally going to sort of appear and be required, and we've heard a little bit about that already. But maybe, Emer, if I can ask you at a high level, what are the sort of changes that you see coming down the track, and how they'll impact, do you think, on the work of the audit committees?
Sure, Kevin, and I actually think that that Slido it's great to see the honesty, because I think everybody, including us here on the panel, feel we don't know enough about it yet, or there's been an element of we kind of know it's coming, but it's kind of comfortable to kick that can down the road. But I think the time for kicking the can is certainly closing in on us. Certainly we've seen a huge uptake in momentum in terms of clients, companies engaging with us in the whole area of sustainability reporting. I guess there are, as you mentioned, Kevin, there are a few key drivers. Everything for us is driven by the EU legislation. I know for the CSRD, the technical standards, I think, are due to be released in May 2022 with an effective date of 23. So that's quite challenging. And I think we kind of know a lot already, or some of us know a lot already. So I think the message, stop procrastinating about it and get on. It's not going to change fundamentally, I think, when it actually is set in stone and comes into place. So what does it mean for entities? And a bit like we talked about the SOX, I think it's seismic for entities in terms of time, commitment, cost, understanding. It is like setting up a kind of new part of your finance function to deal with non-financial reporting. So that's mission critical. And those finance teams, some companies have started to do it already. Some are just at the kind of early stages. So for entities, it's a big deal. For audit committees, it's similar to that. There's going to be an explicit call out when the standards actually do get issued, that there is an onus and an obligation on the audit committees to be responsible for this non-financial information. So that's a change. There's the bit about future of where we're going. That's huge. And then for the auditors, yet to be absolutely finalised who's going to do it, but there more than likely will be an assurance element. And as Colin mentioned there, our opinion will inevitably broaden to cover the glossy front end of the book now, as well as the back for these particular things. So I think huge amount of change, and it's coming at us very, very quickly. And certainly for us in KPMG, we've set up a sustainable futures practice to help us to deal with this, and to help obviously clients in terms of the whole green agenda, etc. So I would say we do not have all the answers. But certainly there's enough people to know, and the biggest message to leave it with is start talking and start getting ready. Okay.
I might just ask you then about another element that's coming in very quickly, which is the single electronic format. And do you think clients are prepared for that? Do you think companies are ready to do that reporting at this point?
Yes, some have been doing it even in terms of, say, like tax returns, etc. So there has been an element, or if you're a US filer, you've been tagging financial statements. So I probably think, Kevin, that's less seismic as the other, the broader sustainability. But again, it's like everything, we tend to like to defer until the very end, and it is coming. So it is another absolute area that people need to focus on.
Okay, and I suppose just one point, if I can add on corporate sustainability, which is its scope. At the moment, it's going to apply to all large companies. So that's perhaps a bigger scope than people might automatically be tuning into. There's a lot of entities there that aren't under sort of formal regulatory scope at the moment. They're going to find themselves within scope for this, and that'll be a challenge for everybody, regulators included, I would presume, at some way down the line. Thanks for that. That was great. Might just then have a look at the questions that have come in on Slido. So just a question there. Actually, it's a good question. The first one there for audit committee chairs. What are your thoughts on auditor and internal audit engagement? So we've talked about the finance function and audit committees and audit chairs. Is this an area that could enhance audit quality? Maybe Donald, to get your view, you talked a bit about
I'm a big fan of internal audit and the role that they play. And on the institutions I'm involved with, we've got 2 internal audits and then 1 outsourced internal audit, which is another topic. But I really do believe that internal audit is a very, very important part of any organisation, and I think that their ability to bring messages around the organisation and the internal controls and how they're operating, etc. I alluded to a little bit earlier. That information can all be shared with the auditor, and I think hopefully down the road with proposals and so on, that we may see more not quite reliance by auditors on internal audit work, but certainly more engagement between auditors and internal auditors around what work is being done, and maybe key focus areas and so on. So for me, I think it's a really, really critical area, and hopefully as we move and some of these proposals in the UK come into force, that somebody might actually address this one. But I believe that it could be very useful for there to be further communications and more deep communications between auditors and internal auditors.
Yeah, absolutely. The next question, the trend seems to be about increasing responsibilities for members of audit committees and directors. And I suppose, Mary, if I could throw that one over to you, what are your views? Is it Is it attractive to become a member of an audit committee?
Well, I think it certainly bears thinking about, and I think people who might be in the frame to do it are being much more careful, not necessarily by doing it, but where they get involved with. So I think non-executive directors, for example, take more consideration about where they become non-executive directors and the controls and the supports and so on within a company. And I mean, there is definitely that trend. I mean, you've seen this with, particularly in the financial services sector. We're going to have SEER coming in, and I think that will focus minds. I mean, coming back to the point about forward-looking statements and so on, I mean, that's where I think we have to be very careful. Producing financial reporting and auditing are very challenging tasks. They're difficult enough as it is. People do take a great deal of responsibility in doing it. And I think we need to be really careful not to add something which is not feasible in terms of predicting the future. I think we need to be really careful how we do that we don't load on something which really, we've talked about the expectation gap. We've got that gap. If you put in another responsibility, I don't think it makes the gap any narrower. Yeah. I think do try to get right what we're doing rather than expanding the brief would be my sense, albeit that, clearly there are some areas where people feel they need more information. Okay, yeah, it's definitely a challenge, and albeit we'd like it to stop, I can't see the responsibility stopping anytime soon. There's a question there that I might direct to Emer, which is around the UK Big Four splitting audit practice. And you've talked about, I suppose, already what you've seen. And maybe just to confirm, from an Irish point of view, do you think that's something, regardless of whether regulation requires it, do you think that's something that, for example, may happen in Ireland because it's happening in the UK, if it goes ahead there or not?
No, well, certainly I think my view is fairly clear in terms of I wouldn't see it as a positive thing, just from, and that's purely from the audit perspective, in terms of having that resource within the firm that we can go to. You end up getting, I'm fundamentally convinced of this, a better quality result. So it does nothing to enhance audit quality, and the client, the company, the audit committee, I also firmly believe gets a better result. And again, back to the point that we were talking about, kind of, that audit, changes in the Bryden report. I do think Ireland will see ourselves more following EU rather than hitching our wagon to the UK. So that's where I think the direction of travel will go. Okay.
And Kevin, just to add, yes. I would agree wholeheartedly with Emer in terms of that disconnect and losing the subject matter expert resource that we currently have under the roof, particularly in complex engagements, quants analysis, actuarial support, and then with all these new obligations that are coming down the tracks. If they're divorced, I would question whether we'd be able to get the same level of quality.
Okay, that's great. Thanks. And maybe just one last question before we wrap up. So, what practical steps can audit committees take to get up to speed on the new sustainability disclosure requirements that are coming in? So, I might get one view from a committee member and one view from an auditor. So maybe, Donal, if I can turn to you, what practical steps do you think?
Yeah, so I think what we're doing now is we're trying to get some advice in terms of actually understanding what are the requirements, when are they coming in, what entities will it relate to, and I think one of the key issues, and I don't think we've mentioned it, is the data requirements that may actually be required for all of this, because it's hard enough putting together sets of financial statements with all of the data requirements, but now we're going to have significantly more data requirements. So how are we going to make sure that the data is good data? Where is it going to come from? And so on. So I think that's going to be a big issue going forward in terms of what systems are people going to use, etc., to be able to put in the information information in the report. So that would be not quite a worry, but that's a challenge, I think.
Okay, and maybe Colin, if I could turn to you then for what auditors can do to help audit committees get up to speed on this, or what are they doing perhaps?
Well, I think it's to get an understanding of what the standards are looking for and what the standards will say, and they're still, evolving somewhat. So it'll be important to understand what is actually required, and then firms are gearing up with suitable resource who can provide assistance in terms of gathering that information. But again, we also need to be careful of the independence and all the criteria that follow.
Yeah, absolutely. Okay, well, that was excellent. I want to thank my panel members. If I could leave us with a couple of takeaways that I've taken from this, I think one is early communications, and early means before even the auditors get in. I mean, the internal audit, the audit, or the finance function and the audit committee, even if it's just the audit committee chair, need to start talking early so that everybody is well prepared. And if there are going to be issues for debate, you air them early before things get very busy. That importance of three-way or perhaps even four-way communication, if we include the internal audit function, so the finance function, the audit committee, and the audit team, they need to be talking openly and honestly and as early as possible to get all those issues out there. I suppose communication is going to change. Communication within the financial reports are going to change. And there's also a responsibility on audit committees and audit firms to improve their quality of communication. We're moving away from numbers now. There'll always be there, but there's a lot of areas such as sustainability and corporate sustainability reporting, non-financial information more generally. And I suppose the final point then is keep looking to the future. Change is only going to keep coming. It's a challenge, but I think there are the skills and capacities within finance functions, within audit teams and within audit committees to be able to meet those challenges. So I'd like to thank the panel. I'd like to thank Emer and Donal and Mary and Colin. We're back on time now, so we're going to take a break for 15 minutes and then my colleagues Barry and Kieran will be back to give an update from the Audit Quality Unit and to talk about Audit Committee outreach. Thank you. Welcome back, everyone. Hope you've had your coffee. I'd now like to welcome to the floor Barry Murphy and Kieran Leddy, who are both working in the Audit Quality Unit. And they're here today to talk about some of our ongoing Audit Committee initiatives and to give the results of a recent Materiality Survey undertaken by Audit Committee chairs. So Barry, over to you.
Thank you, Kevin. Good morning, everyone. This session of this morning's briefing will focus on the work of the Audit Quality Unit. I will give the results of the 2020 audit inspections. I will speak a little bit about a new initiative we launched in 2021, where we interviewed a number of audit committee chairs. I will then talk a bit about a new audit committee questionnaire that we were involved in. And finally, my colleague Kieran will give an overview of the results of a recent materiality survey that was carried out amongst audit committee chairs. So 2020 was the third round of inspections, and it was the second year the firm-wide inspection reports were published. There were no significant changes to the format or content of these reports, and similar to the previous year, they included both the results of our review of each firm's system of quality control and the key recommendations arising from our reviews of individual audit files. As it currently stands, there are 7 audit firms within Ireland that carry out the audits of public interest entities and are therefore within IAASA's inspection remit. This is one less than the previous year, and this was due to one firm resigning from their PI audit clients. IAASA uses the Common Audit Inspection methodology when carrying out our inspections, and this is a work programme used by a number of European regulators. We also continue to monitor our risk matrix in order to ensure that we are capturing an appropriate sample of public interest entities for our inspections. So what is the current shape of the PI population within Ireland? So this chart demonstrates that there has been a small drop year on year, although it's interesting to note that between 2020 and 2016, there was a 50% drop in the overall PI population, whereas as can be seen from this chart, the constriction remains, although it has stabilized somewhat, and there has been very little movement year on year, with the exception of some of the listed debt entities. Looking at how this impacts the audit market itself, Big Four audit firms still account for the vast majority of audit fees earned from PI audit engagements, although it's interesting to note that non-Big Four firms now account for 25% of the total PI audit population, i.e. the number of PI audits that are carried out. And the main PI audits that are being undertaken by non-Big Four firms are predominantly the debt listings, although there are some exceptions to that. So this slide sets out the results of the 2020 audit inspections, and we have also included the 2019 results for the purposes of comparison. So 87% of audits inspected received a grade of either 1 or 2, indicating that the quality of these audits was of a good standard. 2 audits inspected were assigned a grade of 3, and there were more substantial issues detected here as part of our inspection, and 1 audit was assigned a grade of 4. We would emphasize that the above results represent a small sample of the overall PI audit population, and the conclusions about the overall standards or the overall quality of audit in Ireland cannot be drawn from this sample. One of the most common findings arising from our inspection was in relation to IASA 220, which is the auditing standard which relates to quality control. Our inspections detected deficiencies with both the review carried out by the engagement partner and also the engagement quality control review. So this is the additional quality control review which is required for public interest entities. And our inspections detected instances and issues with this review failing to detect issues with the quality of the audit work performed. So my colleague Martin Kelly has already talked about some of the issues that we detected in relation to IASA 701. And we did detect a number of findings in this area relating to a failure by the audit teams to document the rationale for the key audit matters identified. And in some instances, a failure by the engagement team to communicate the key audit matters to those charged with governance, including audit committees. So in relation to the inspections, one of the new initiatives we commenced during the year was our interviews with audit committee chairs. So we see this as an excellent opportunity to engage with audit committee chairs who are sometimes a section of the market that we don't always come into direct contact with. The main emphasis on these interviews were to understand the engagement between the audit committee and the auditors, and to get the audit committee chair's perspective on the performance of the audit, what worked well, and if there were any constructive points for improvement. We think it's important to note that these interviews were not an assessment of the work of the audit committee and are focused instead on the work of the auditor and their interaction with the audit committee. So the outcome of these results was very positive in that it was clear to us that there was frequent and open communication between the audit committees and the engagement teams. And this was right from the planning stage and risk assessment stage of the audit all the way through to completion. It was also apparent to us that in a number of instances, the audit committee had challenged the engagement team on the appropriateness of the significant risks and key audit matters identified. One thing we did find interesting, however, was that not all audit committees had read the audit firm's own transparency report or the IAASA quality assurance review report. So we would emphasize that these reports are freely available and they are an important and useful source of information about auditors. So our plans for 2022 are to continue the rollout of this interview process to all public interest entities. So in the current year, our sample selection focused on the large equity listed PIs. So we'll now look at the wider population going forward. Another big initiative that we're currently involved in is a new audit committee questionnaire, which is currently being rolled out across Europe. This is an online questionnaire which consists predominantly of multiple choice questions, and there are 34 questions in total, which include questions on the interaction between the audit committee and the board, questions around independence, which includes a number of questions on the provision of non-audit services. Where the audit has gone out for tender during the period, there are questions on the audit selection procedure and the criteria used by the audit committee in selecting the new audit firm. There are questions around how the Audit Committee monitor the audit, and questions around how they engage and interact with the engagement team throughout the audit process. And finally, there are questions on how the Audit Committee monitor the financial reporting process. We would strongly encourage any audit committees requested to complete the survey to do so, as our questions are based around the legislative requirements for audit committees, and they include a number of practical examples within the questions of how you can and should be fulfilling your responsibilities as a member of an audit committee. If any audit committee chair watching is interested in completing the questionnaire, please feel free to reach out to us after the presentation and we can provide you with the relevant links. I would just like to emphasize that these questionnaires are confidential in nature. The responses and results will be aggregated and no individual responses will be made public. So at this point, I would like to hand over to my colleague Kieran, who will take you through the results of the recent Materiality Survey that was conducted amongst audit committees. Thank you.
Thanks, Barry. Good morning, everyone. Today, I will give you a brief overview of a recent survey sent out to audit committees on materiality. Again, to ensure everyone is up to speed, I will talk about the concept of materiality at a very high level before looking at the results of the survey, and I'll finish out with some key messages for audit committees on materiality. Iasa was asked by the European Group of Audit Regulators, the CAOB, to carry out a survey on materiality in audits during 2021 for audits with year ends in 2020. The objectives of the survey were to provide stakeholders with an explanation of the concept of audit materiality and how it affects the scope and extent of the auditor's work, to provide stakeholders with an overview of the current practice at the largest firms, and to collect the views of audit committees on the concept and application of materiality and their interactions with the auditor. To start, as a quick refresher for everyone, I will quickly run through some of the fundamental principles of materiality. Auditors apply the concept of materiality in planning and performing an audit of financial statements, in evaluating the effect of identified misstatements on the audit, if any, and informing the opinion in the audit report. A misstatement or a number of aggregated misstatements are considered to be material if they could influence the economic decisions of users of the financial statements. The auditor's determination of materiality is a matter of professional judgment, and determination drives the scope, the nature, and the extent of the work the auditor performs. Materiality is initially determined at the planning stage of the audit. Auditors will determine overall materiality, performance materiality, a clearly trivial threshold, also known as an audit differences reporting threshold, and if deemed necessary, a materiality level for particular classes of transactions, account balances, and disclosures. Overall materiality is the amount over which it is anticipated that misstatements would influence the economic decisions of users of the financial statements. Generally, auditors determine overall materiality by selecting a relevant benchmark, such as profit before tax, revenue, or net assets, and applying a percentage. Auditors consider a number of factors and apply professional judgment in determination of the appropriate benchmark and the percentage to be used. Performance materiality is an amount less than overall materiality. The lower materiality is to allow for the risk that there may be several smaller errors or omissions that have not been identified by the auditor. These smaller items could be material when aggregated, so the performance materiality level is set to capture these. The clearly trivial threshold is the threshold set by auditors below which misstatements are deemed trivial. Misstatements below this threshold are not accumulated by the auditor and not recorded on their summary of misstatements unless they consider them important from a qualitative perspective. It's important that audit committees understand how this threshold is applied and, if necessary, agree on certain classes of misstatements below this level which are required to be reported to the audit committee. A clearly trivial threshold is calculated as a percentage of overall materiality. In practice, this is set at 5%. While not widely used, the standard allows auditors to determine specific materiality level for specific classes of transactions, account balances, or disclosures. Areas where this is commonly used include related party transactions or director emoluments. The table in this slide shows, in percentage terms, the benchmarks used by auditors to determine overall materiality for audits included in the survey. As you can see, net assets was comfortably the most commonly used benchmark. There are a couple of factors driving this, including the industries that were part of the survey sample and the impact of COVID-19 on PBT levels of entities, which as a result, entities favoured a more stable benchmark such as net assets in 2020. 38% of the surveyed entities changed either the benchmark used or the percentage applied to determine overall materiality. As part of the survey issued to audit committees, we asked for their views on the most suitable benchmarks for determining materiality in their audit. We did note a couple of instances where the benchmark used by the auditor differed from the benchmark considered most suitable by audit committees. In these cases, what is most important is that there was discussion on the benchmark chosen and agreement between the audit committee and the auditor. Questionnaire responses do indicate that these conversations are taking place, which is encouraging. The table in this slide shows the percentages applied or the percentages applied to the chosen benchmarks used to determine overall materiality in audits included in our survey. As you can see, the percentage applied to PBT and revenue benchmarks was pretty consistent across all audits. In terms of the net assets benchmark, the range of percentages applied was pretty wide across the surveyed entities, including when looked at on an industry by industry basis. The next couple of slides set out some of the initial observations and findings from the survey. In general, audit committees' understanding of the materiality concept is strong, and in most cases, audit committees do place moderate or high importance on materiality, including in consideration as part of the audit proposal process. Materiality discussions are taking place at the planning stage of the audit and throughout, and audit committees are generally satisfied with the materiality levels being used by the auditor. We have, however, identified some areas based on the survey results where audit committees could benefit from a deeper understanding within materiality. Audit committees should ensure that they understand the factors that were considered by the auditor in setting materiality, specifically in relation to the determination of the percentage applied to the chosen benchmark to calculate overall materiality, and in determination of the haircut percentage applied to calculate performance materiality. Audit committees should ensure that they understand how the auditor uses performance materiality to determine the extent of their audit procedures. And audit committees' understanding of these areas and other areas within materiality would, in general, benefit from a more clear and concise communication with the auditor and enhanced discussions in relation to materiality. In the next couple of slides, we have set out some of our key messages for audit committees in relation to materiality. The section sets out a number of questions that audit committees should ask themselves in relation to materiality, as well as questions which can help drive conversations with auditors in relation to materiality. In the interest of time, I don't propose to go through this section in detail now. The slides have been or will be made available to participants after this session. If I were to pull out one key message from this slide, it would be the top line there. Basically, it says, have you understood and challenged the basis for the materiality level set? This slide here sets out a couple more of the key messages for audit committees, which again, I won't go through in detail now, but you're free to digest at your own leisure. And finally, in terms of next steps, we plan to publish a thematic review of materiality in audits before the end of the year. This will provide an Irish perspective on materiality and will build on the initial observations that have been set out in this slide deck. This will be published on the IAASA website as well as on our social media channels. Furthermore, the CEAOB will be publishing a thematic review on materiality, aggregating the survey results across participating jurisdictions. I don't know the exact date that this will be published, but it will likely be Q1 or Q2 of 2022. Thanks for your time. I will now pass you back to Kevin to introduce the next session.
Thank you, Kieran. Very good. Okay, for this last session, we are delighted to have Alain Deckers speaking from Brussels about some of the major regulatory changes coming down the track. Alain heads the unit responsible for corporate reporting, audit, and credit rating agencies. The topics he's going to cover today include the Corporate Sustainability Reporting Directive. You've heard a little bit about that already. He'll be discussing it from a legislative perspective, looking at the timelines and their impact. Alain will also cover ESEF, the European Single Access Point, and he will be giving us an update on a current EU study assessing both the EU regulation and the directive. So if there are any questions, I would ask you to use Slido, and we will try to get to as many as possible at the end. So thank you, Alain, for taking the time to speak with us today, and I'll now hand the floor over to you.
So thank you for this, for the invitation to speak at this event. I think it's always very good to reach out to audit committees, which are really a key component of the ecosystem that is essential to ensure that audit is working correctly. I'm going to proceed in sort of three blocks. First, I'll say a few words about recent developments in audit at EU level. And really, the common theme in that block is that audit really is moving beyond the traditional scope of historical or retrospective financial information. I'll cover SF and sustainability reporting in that context. And this is partly driven by law, but it's also a broader market development that we can see happening, not just in Europe, but across the world, actually. Secondly, I'll then turn to a few questions about the effectiveness, if I can put it that way, of audits. And lurking in the background, there is also the question about the structure of the audit market. But this has to be looked at in a broader context. It's not just audit on its own. And I'll say a few words about the work we're doing, including in the context of the study that we've launched to look at as I said, it's effectiveness of audit, but more broadly, the quality of corporate reporting and the effectiveness of the EU's legislation to deliver quality corporate reporting. And then thirdly, I'll turn to ESAP, which is a related but somewhat distinct project, the European Single Access Point. That's really something that we're dealing with the Capital Markets Union project, and it deals with a broader objective of trying to promote market integration across Europe. But it also has some relevance to audit. So turning back to the first point then, as I said, I want to focus here on SF and the Corporate Sustainability Reporting Directive. And I remember when I first became involved in, I first took over the audit unit in the Commission in 2015. SF was still sort of, at the time, seemed to be a distant prospect, but in the meantime, it really has materialized. And it struck me that the move towards digital reporting should not entail a different level of protection for users of financial information, depending on how they consume the information. Whether they consume the information in a traditional format, that is to say, paper or traditional sort of PDF, or whether they consume the information in a machine-readable format. And looking at the SF legislation, we have an audit requirement also for this digital information. And since then, there's been a lot of work done on this, including at the level of the CEAOB, the Committee of European Audit Oversight Bodies, which has produced some guidelines in this respect. And no doubt there will be continued work that has to be done, including perhaps at the level of standard setting by the IAASB, the International Standards for Audit. Similarly, in the field of sustainability reporting, when we engaged in the review of the CSRD a few years ago, we started this work a couple of years ago, it struck us that the very stark distinction which existed between the audit requirements for financial information and for what then and still today we refer to as non-financial information seemed difficult to justify and maintain. Financial information, as we all know, is subject to a reasonable assurance requirement. The non-financial information in the NFRD is entirely carved out from any kind of audit requirement. It's even carved out from the consistency check requirement that the auditor normally undertakes between the management report and the financial statements. So given the increasing importance that sustainability or non-financial information has in capital markets, again, this very stark difference in treatment of the two types of information seemed to us to be difficult to sustain. And that is why in the CSRD proposal, we have introduced a proposal to subject the sustainability information, as we now call it, in the proposal, to a assurance or audit requirement. We have proposed to start with a limited assurance. There are a number of reasons for that. First of all, the nature of sustainability information is a bit different from traditional historical or retrospective financial information. It often has a much more important forward-looking component. Can I just check if sound is working? Because I'm getting messages stating that there is a problem. No, it seems to be okay. Thank you very much. That is a sort of a technical difference, but also there is a limited experience in relation to a reasonable assurance of sustainability information in the market, and we did not think it would be wise for those two reasons and some others too that we should move directly towards reasonable assurance. So that is a sort of a general indication of the increasing importance of audit and the widening scope of audit requirements with reference to two very specific regulatory developments. But as I said, this is also a trend we observe more broadly in the market. Indeed, there are some companies that already, it's more pronounced in some jurisdictions than in others, but that already are looking to obtain a reasonable assurance of their sustainability reports, for example. Now, this increasing scope and relevance and importance of audit, of course, raises the importance of ensuring that audits are performed effectively. And there's been a lot of excitement in the last year in Europe, of course, about the Wirecard case, which was raised a lot of questions. Now, we all know there are some specificities about the Wirecard case. It was a case of what seems to be quite clear criminal fraud, and it's unlikely that external audits, certainly by itself, will be able to eliminate all cases of criminal fraud in financial reporting. Having said that, we have already also seen in recent years a number of difficult cases in other jurisdictions, including in the United Kingdom, while it was still a member state and applying the EU's legal framework. So that has led us to assess or to conclude that we need to proceed with an assessment and evaluation of the audit legislation, which has now been in effect for about 5 years. So that would be the sort of normal period over which we would normally proceed to an evaluation of EU legislation. And indeed, that is what we are now doing. And we're looking at this in 3 distinct pillars, if I can put it that way. The first one we can broadly refer to as the corporate governance requirements that surround the reporting process, and that would include the role of audit committees. Secondly, external audit, issues that I've just referred to. And the third pillar would be supervision. And when I refer to supervision, I mean both the supervision of corporate reports or financial statements, which generally, at least for listed companies, of course, is a responsibility of securities authorities. Although there are specific arrangements in each member state, and Ireland is an example of sort of where responsibilities are also involve IAASA, but also the supervision of auditors. And you will see that in the near future, in the next few weeks, we will be publishing a call for evidence and a public consultation dealing with all 3 of these pillars. This will not yet be in any way suggesting what the solutions might be or whether the Commission needs to legislate on this point, but just trying to identify exactly what the concerns are, what possible actions might be, and that may then lead to a legislative proposal towards the end of next year. So again, I want to emphasize audit is a very important component of this, but we think we need to look at audit in a broader context because there are very strong interactions between these 3 pillars. For example, if I look at the corporate governance pillar and the external audit pillar, clearly if there are greater responsibilities put on the shoulders of boards of directors or audit committees, perhaps, then that may also feed into procedures that the external auditor has to perform. I'm not suggesting here that we should necessarily move towards a Sarbanes-Oxley system such as they have in the US, but it's just an illustration of the possible interlinkages that there are between these 3 pillars. And as I said before, lurking in the background of many of these debates, of course, there is a broader concern about the market structure of the audit market in Europe, which is a very highly concentrated market. There's been a lot of discussion about that in the UK, notably. And that is perhaps something we will need to look at too. I will turn now towards the third pillar, the third element I wanted to mention, which is the European single access point. And then I want to leave some time for questions. So I will try to deal with that relatively quickly. So the European single access point, it's not something that's specific to audit or even corporate reporting for that matter. It is a project that tries to, whose objective is to ensure or enhance the accessibility and usability of information that companies are required to disclose according to EU law. And when I say information that they have to disclose, this goes far beyond the annual or even semi-annual or in some cases quarterly reporting bundles. We are looking at quite a wide range of legislation, including, for example, a point that's been mentioned earlier in the previous presentation, transparency reports for auditors could be one of the elements that could be covered by the ESAP. But I mentioned the two main objectives of the SAP, which is to enhance the accessibility of information disclosed by companies and its usability. Accessibility mainly tries to address the consequences of the distributed governance model we have in Europe, where information currently is disclosed in a range of different registers and databases spread across Europe, sometimes at national level, sometimes at European level. And for a user, therefore, trying to access or find even all this information that companies disclose can be a challenge. Some people have sometimes referred to this as a finding a needle in a haystack. There are, of course, commercial data aggregators that try to provide solutions. Those are, of course, not for free and sometimes beyond the reach of some categories of users in terms of price. And therefore, our objective is to ensure that from a user perspective, there can be an interface that provides a seamless access across the whole EU to a wide range of information that is disclosed by companies. We're still working on the details of this, on the exact governance, but we will make a proposal later this year. When I talk about usability, I refer to a large extent to the digitalization of company information. We've already moved ahead with this in some areas. The SF is, of course, one example. And as those of you who are familiar with our CSRD proposal will know, we have proposed in that legal initiative to extend the digitization based on the SF model to sustainability information that companies will disclose pursuant to the CSRD in the future. But there is a much wider range of information that companies are required to disclose according to EU law. And our objective is to try to make as much of that available in a digital format so that that information can be easily extracted and can become machine readable. That doesn't necessarily mean that we would impose something like the SF model with full tagging requirements and so on for all categories of information. But the very least is that it should be easily machine readable and reusable, so that it is also more easier to analyze that information. More generally, our objective with the SAP is to try to contribute to market integration across Europe. At the moment, as I said, information is very fragmented across Europe. Company information is very fragmented across Europe, and that, to a certain extent, reduces the attractiveness of cross-border investment, in particular in small, less liquid markets in Europe. So we hope by this project to also contribute to the broader objectives of the Capital Markets Union action plan, that is to say, to promote the development of capital markets across Europe, but also promote the integration of capital markets across Europe. Kevin, what I propose is to stop now, perhaps, and again, leave enough time for questions, and very happy to take questions either from yourself or from the audience if you have them. Thank you.
Thank you, Alan. That was really useful. One of the sort of key takeaways I took from that, and I'd like your view on it, you started talking about when you joined and that ESEF was on the agenda back then, and we're getting to it this year. If I can say it historically, that was perhaps the pace of change within Europe. But what you've talked about since is a succession of things that are all coming. And there is a new pace of change. Things are happening on a greater scale and more quickly. Maybe just get your view on how the European process is coping with that. What is being asked of the Commission and Parliament, and how they're addressing the demands for greater and quicker change from the system.
Well, I think there is a realization in Europe that to a certain extent we are behind the curve. If you look at the US, they introduced XBRL quite a number of years ago. They've now transitioned to IXBRL for tagging of financial reports. And similarly, we have also similar developments across a wide range of jurisdictions in Asia, for example. So to a certain extent, we are behind the curve in terms of digitization. And to a certain extent, we're dealing with challenges that are very specific to Europe. I mentioned before the sort of multi-level governance model that we have in Europe. That, of course, is a very different situation for compared to what exists in the US, where there is a single jurisdiction with a single supervisor and a single set of legislation. So that degree of market fragmentation doesn't exist in the US for historical reasons and for reasons that are more broadly linked to the legal and administrative structure in the US. So I don't think it's a question that we're sort of slow compared to others, but we do have specific challenges in Europe that we have to deal with. Now, the challenge here in Europe, of course, is that we have to legislate for many of these things. And many of these developments are highly technical, and therefore the big challenge from a regulatory point of view is to put in place a system that provides all the legal certainty necessary in what we would call the level 1 measures, that is to say the directives and the regulations that we adopt, but still provide sufficient flexibility to quickly incorporate technical changes. Now, this is not trivial. We found a solution for SF. This is one of the points which I think will also be a matter of considerable debate during the legislative process on the CSRD, because, of course, the legislators and the representatives of the member states want to have that legal certainty in the European secondary legislation. There's a careful balance to be drawn so that we still have the flexibility to adapt to these technical changes and to keep pace with the changing requirements. For example, if I look at SF, we now do annual amendments of the annexes of the SF regulation. This is quite an involved process. Apologies, my phone is ringing. This is quite an involved process, and we every year really struggle to make sure that we have the new tagging requirements required by the new accounting standards produced by the IASB on the books, on the statute book, in time for the start of the new reporting year. So there are certainly challenges, but I think the system so far seems to be coping. And as I said, I think there is a real realization now that on all these digitization aspects in particular, we really need to make progress in Europe. I think if I look at the sustainability reporting front, there the situation is perhaps somewhat different because I think there Europe is a little bit ahead of the curve, Indeed, that is leading to some discussions about how do we ensure compatibility with developments at international level and so on, which are important and we are committed to undertake. But there, I think Europe clearly has a possibility to shape matters because we are seen as a front runner.
Okay. And that leads us nicely into one of the first questions we've had from our audience, Alain, and that refers to the timeline for those sustainability standards, which is talking about sort of mid next year. And I suppose, the question was around, do you think that will be achievable? It's a very challenging timetable that Europe has set.
Yes, it certainly is a very challenging timetable. I think everybody recognizes that. In a perfect world, we might have started or dealt with the sequencing of different measures in the area of sustainable finance in a slightly different way. But because of historical contingencies, that just wasn't the way it went. So we're now faced with a situation where asset managers and other so-called financial market participants are required to disclose information about the sustainability characteristics of their products and investment portfolios and so on. And of course, in order to be able to do that, they need to have access to information from the companies in their portfolios. Hence, there is considerable pressure from the financial industry to accelerate the transition towards better disclosure by investee companies, and that to a certain extent explains the urgency and the very challenging timetable that we're now confronted with. Now, you know that EFRAG the European Financial Reporting Advisory Group, has been working at considerable pace, both to develop general recommendations about the way to develop sustainability reporting standards. Those recommendations were published in early March. And there's a project task force working under EFRAG's corporate reporting lab at the moment that is also working very intensively. And I can tell you that over the summer, there were quite a lot of people working who gave up their summer holidays basically to keep this process going, to develop proposals on the details of the reporting requirements that need to be set out in future standards. Earlier this year, about a month ago, EFRAG published a first working document which sets out some preliminary considerations focused on climate reporting, which is, as everybody knows, an area that's somewhat more technically mature than other areas of sustainability reporting. But work is also proceeding intensively on other areas, and the project task force is meeting. I think there is now a plenary almost on a weekly basis, and there are several working groups that are being established, and there are specific clusters under the task force that are dealing with the different topics. So there's very intensive work going on, also to reform the governance of EFRAG, to establish the new sustainability reporting pillar. And we are confident that work is on a good track. Now, exactly where do we land in the legislative negotiations that are ongoing about this CSRD proposal? That is something that, of course, remains to be seen. But at least I'm confident that the work is on the tracks and that we're making good progress towards the objectives that we've set ourselves.
Yeah, and that EFRAG document that came out, as you say, recently enough, I think that sets a very good roadmap, really, to allow people attending here this morning to get a sense of the direction of that particular element. I have two related questions that came in here, Alan. One was around, how far do you think some audit reform, or how radical do you think some of the audit reform proposals might be coming out of the review? Mm-hmm. And related to that, do you think that the EU will consider some of the proposals that have emanated from the UK, which obviously they've had a very radical and deep review of the whole concept of audit? Do you think Europe will be considering some of those in its review?
Certainly. Well, let me deal with that second question first, because to a certain extent it's easier. I don't think we need to, in this context, consider the somewhat fraught discussions with the UK on other topics. But I think it would be foolish on our part not to look at the work that's been done in the UK. As I said, a lot of the cases that triggered the various reviews that have been undertaken in the UK date from the time when the UK was still a member state and operating under the EU's legal framework. So I think there certainly is a case to argue that there are lessons for us to learn also from those reviews. Now, some of what the work that's been done in the UK is rather UK specific. For example, if I think about the transformation of the Financial Reporting Council into the new Accountability and Governance Regulatory Authority, I think is still the name that's being considered. That's rather UK specific. But some of the broader reviews such as the Bryden Review and also some of the work that's been done by the Competition Markets Authority is certainly of interest to us, as is the consultation document that the UK published a few months ago. So yes, we will be looking at that, but you shouldn't necessarily expect that we would reach the same conclusions. I mean, and that leads me to the transition to your first question: what might be the outcome of this? Kevin, I really think that it's premature to answer that question. And also it would be foolish and dangerous for me to try to answer that question at this stage. These will be decisions made at political level, and I'm sure Commissioner McGuinness will want to have a very close look at all of these topics before taking any decisions about the way ahead. So in order to show, I'm going to decline to answer that question at this stage.
Okay, and on that basis, there's a couple of other questions which I won't tax you with around expectations that the definition of a PIE will change, or around the technicalities around the assurance on sustainability reporting. I think probably the same answer to those, which is that there's a lot of detailed consideration to come. Another question here, which is relevant, and it talks about all the different options that there are currently in audit legislation and the sort of opt-ins and opt-outs. And because of that there can be an inconsistency amongst regulators within the EU. Do you think that as part of this review that there's going to be more harmonisation?
Yes, that's a very interesting question. I referred earlier on to some of the things that struck me when I first took over responsibility for audit legislation in the EU at the Commission. And the extent of national options in the audit regulation was also one of the points which really struck me. From a purely personal point of view, and this is not the Commission's official position, but it's a sort of somewhat lighthearted comment from my side. I sometimes say that the audit regulation is actually a directive masquerading as a regulation, because there are so many options in that regulation that it gives member states a very significant margin of discretion about how to implement that. And that affects a range of important issues, whether it's rotation periods for audit firms, whether it's the choice of or the restrictions on non-audit services, and the list goes on. That, in my view, does raise questions about how, in particular, multinational firms that have PIEs operating in several member states, that's perhaps particularly severe for financial institutions, banks and insurance companies, because every subsidiary in a group that is a bank would be considered a PIE and therefore subject to the regulation. That raises questions about opinion. It raises questions about the integrity, even perhaps, of the group audit. And it may also have some unintended consequences in terms of the actual ability of auditors, even among the Big Four, to bid for audit contracts. Given the fact that they would have to be very careful about how they manage non-audit services that may imply conflicts according to the audit regulation. So it's an issue that perhaps needs to be looked at. I have to say, though, that these options are there not by accident or mistake, but because member states fought very hard to maintain those options. And therefore, we will have to see, should there be a proposal to try to limit or perhaps even eliminate these options, how the political debate goes about those, because I am sure that if we go in that direction, member states will not simply lie down and say, okay, you can get rid of all my national options, and we'll just have, for example, a single rotation period applying across the whole of Europe, or a single list of non-audit services. So that might be an interesting but somewhat difficult debate that we have if we go in that direction.
Okay. There's another question here relating to the provision of assurance on sustainability reporting, and will it be reserved to statutory auditors, or will it be possible for other providers to provide this? So I'm aware that the legislation at the moment indicates there could be these other assurance providers. What's your sense of how that issue is developing and the thinking around that issue? Do you think that's something that will remain and gain traction, or do you think that might be one of the more challenging elements of the proposals?
Sorry, Kevin, my connection broke again, and I heard you mention an issue, but I don't know what issue it is.
It's the issue relating to other assurance providers might be able to provide the opinions on sustainability reporting as well as auditors. And I'm just asking whether you think that's something that will gain traction, it'll remain, or do you think it might be one of the more challenging elements to introduce?
Well, again, this is an issue that we're discussing at the moment in the in the council working group that's dealing with the CSRD proposal. It's a model that's already used in one member state, not very widely, because again there are very few member states that transpose the NFRD. And at the same time require an audit or assurance of non-financial information. The sort of usual questions are arising on that. How do we ensure a level playing field between auditors and these other independent conformity assessment bodies? So I'm sure that debate will continue. Whether it gains traction more widely remains to be seen. We have tried to base this on a model available across Europe based on accreditation, subject I worked on some 20 years ago, for which there is a regulation that determines how accreditation needs to work in the EU. So we have a basis to build on if this becomes something that has traction, but I'm sure there will be many more discussions about that.
Okay, there's two final questions, and I'll allow you to take them together, Alain. The first is, do you think there's any expectation that the definition of a PI will change? And then the next question, and this is of direct relevance to the people attending the conference here this morning, many of these developments will have an indirect impact on audit committees, but do you think there might be any changes that will directly impact on governance and, by extension, on audit committees' responsibilities?
On the definition of PIs, again, I don't know. I think we're not yet at the stage where we can go into that level of detail. So I'm simply not in a position to answer that question. We'll have to see. On the second point, you can see already in our CSRD proposal that we've tried to align the responsibilities for sustainability information with the responsibilities that audit committees have for financial information. So that is an example where we think there needs to be a governance process around sustainability information that is comparable to the governance system that there is around financial information, given the increasing importance of sustainability information in investment decisions. Indeed, I've spoken to some investors who even say that sustainability information is in some cases now even more important than historical financial information in decision making. And that means that we need to ensure that the reporting process is robust. And the obvious way to do that is to build on the experience that we have with financial information. So in the CSRD proposal, we have foreseen, for example, that there would be an extension of the responsibility of the audit committee. Now, some people have asked, does that make sense? Would the audit committee be able, or would it be possible to include all the expertise within an audit committee to undertake that responsibility? So there may be other board committees that have responsibilities in the area of sustainability reporting, and we'll have to see exactly how we come out of that. But I think what's important for us is, given the importance that sustainability information has now in markets, there needs to be a robust governance process around that reporting process.
Okay, listen, Alan, thank you so much for giving us your time this morning. What you've told us clearly is that you're a very busy man with a very busy team. I hope and I'm sure that our attendees this morning have gained a huge amount from the information you've provided us with. So thank you, Alan.
Thank you very much.
So we've come to the end, and I think we've ended it on a bit of a high there. Really, really good to hear the views from Europe, not just on how and where we've got to where we are, but where we're going into the future as well. And really, we're hearing a lot about change and increasing responsibilities for audit committees and indeed for auditors and for regulators. A few thank yous. I'd like to thank all the speakers. I'd like to thank my fellow panelists. I think that was a very interesting session as well. I'd like to thank the team who worked here today to make everything work so smoothly. Thanks Mairead, thanks Trina, and thanks to Barry Tully also. I'd like to thank all you. And hopefully you found this really useful. We are looking for your feedback, so there'll be a link that will be made available to you so that you can see, or sorry, you can tell us what you think worked, what you think might improve into the future. So what we might do now is we might take a final look at that first Slido question we asked, which was, what do you think will be the challenges in a virtual setting? So 3 big items there. First of all, audit comfort in a virtual setting. So this is the second year of this for auditors and audit committees, for many of them anyway. A lot of work was done last year. As regulators, when we carried out our inspections, we were making sure, and the message we clearly communicated was that standards remained the same, whether you're doing an audit on site or virtually or a hybrid. And one of the things I think we will actually see going forward, and it's something as regulators we will monitor, I think it's something audit committees should be monitoring as well, is what sort of permanent changes you'll now see and how an audit is undertaken now that the technology has been bench tested, so to speak, and we know the capabilities. At the same time, there is no replacing the looking people in the eyes and doing that sort of work on site. The impact of COVID-19 on financial statements, that's a very important issue for audit committees. We're looking now at the unrolling of government supports. There are reports in the media increasingly that liquidations and insolvencies have been held back, but now that there's going to be an increasing number of those. So if you look at the standard requirements and going concern, they're something now that in the first instance, the finance function and the audit committee and then the auditors are really going to have a look at and take some hard, objective, potentially skeptical views on whether these businesses are going to survive. Fraud is the other big word there. So there is a new standard coming out that IAASA has issued in relation to fraud. And again, what that's really getting at is the auditors taking more objective, potentially more skeptical view, effectively trying to seek out where there may be instances of fraud, not just taking the messages of management as read, where they're making representations, but also to seek out where perhaps audit evidence counters that sort of information that the directors and the finance function supply to auditors. So it's providing a new perspective for auditors on how they deal with fraud. So they're the 3 main ones. The other ones there, regulation. It should be something I think that is on every audit committee's list. I hope that the work of IAASA in terms of, for example, our audit inspection reports are part of the supports, and indeed this session this morning are part of the supports that regulation provides to audit committees and allows them to do their work better. Disruption due to cyber incidents, and we're seeing that obviously all the time. We've had one of the most significant ones in global history in this country with the HSE this year. So it's really, I think, got to be top of every organisation. And in terms of the internal control function, the IT control that we talked about in the panel this morning, for example, cyber incidents and cyber control is huge in relation to that. Sustainability disclosures, impact on environment, we've talked a lot about that. And then increasing regulation and pace of change, I see there as well. And what we've heard is, yes, it's there, but very much it is responding in many ways to the demands of the market. So if you look at sustainability reporting, to give one example, there are countries and there are companies that are already doing this, and there are investors and other stakeholders who want to see this. So this is really the market responding to all those sorts of things. So that's great. Listen, thank you very much. We've had a really enjoyable morning here. I hope you found it a very enjoyable morning too. Looking forward to hearing your feedback and seeing how we can improve this and retain what's good within it. So thank you all very much and have a good day.